The Fall of Lehman Brothers, 24 hours that decided the fate of the global economy. Prologue, the file reopened, listen. A phone rings, then another, then a dozen at once, overlapping, unanswered, ringing into empty rooms. Footsteps, fast ones. Leather soles on marble echoing through a lobby that until this week had never once doubted its own permanence. This is the sound of 745 7th Avenue, Manhattan, in the final hours before dawn. A tower of glass and steel, a name etched above the entrance in letters that had stood, unquestioned, for 158 years. Lehman Brothers. By the time the sun rose that morning, the ringing had stopped. The footsteps had slowed, and in their place came something the world would not forget. Men and women, some in suits, some still in the clothes they had slept in at their desks, walking out through the front doors carrying cardboard boxes. Photo frames, coffee mugs, a framed certificate from a job that as of that morning no longer existed. One photograph from that morning would circulate around the entire planet within hours. A young analyst, box in his arms, staring somewhere just past the camera. Not angry, not crying, just hollow, as if some part of him were still inside the building, refusing to believe what had already happened. The date on the front page the next day read September the 15th, 2008. And the question every one of those front pages asked in one form or another was this: what could bring down an empire that had survived the American Civil War, 2 world wars, and the Great Depression of 1929 in a single weekend? Not a single weekend of war, not a single weekend of natural disaster, a weekend of meetings, phone calls, spreadsheets, silence. That is the file we are opening tonight. Because what happened to Lehman Brothers was not an accident. It was not bad luck or a storm that simply could not have been predicted. It was the final chapter of a story built, piece by piece, over years, by ordinary human forces that have brought down empires long before Wall Street existed. Greed, arrogance, blindness disguised as confidence, and decisions made behind closed doors by a handful of men who believed, right up until the very last hour, that they were the exception to every rule that had ever applied to anyone else. Here are the numbers, so you understand the size of what we are about to walk through. More than $600 billion in assets, gone in a single filing. To this day, it remains the largest bankruptcy in the history of the United States. Within months, roughly 8 million Americans would lose their jobs. Millions of families would lose their homes. And stock markets across the entire world would erase trillions of dollars in value in a matter of weeks. A shockwave that began in one building, on one island, in one city, and reached almost every economy on Earth. This is not simply the story of a company that failed. This is a case file. And like every case file worth opening, it has a beginning, a body, and a group of people who were in the room when the decision was made. The decision that would ripple outward into the lives of millions of people who had never heard the word Lehman in their lives. Over the next 12 chapters, we are going to walk through this file together, piece by piece. We will go back to the glory days of the empire, how a company built on selling cloth in a small town in Alabama became one of the most powerful investment banks on the planet. We will trace the first hairline cracks, the warnings that were heard and ignored one by one until ignoring them was no longer possible. And we will spend real time inside the 24 hours that gave this story its title, the 24 hours inside the Federal Reserve Bank of New York, where the fate of a 158-year-old institution, and arguably the global economy itself, was decided across a handful of tense, sleepless meetings. 3 names will follow us through nearly every chapter of this file. Dick Fuld, chief executive of Lehman Brothers for 14 years. The man Wall Street nicknamed the Gorilla for his temper, his instincts, and his absolute refusal to believe his empire could ever fall. Hank Paulson, the Secretary of the Treasury of the United States, a former Wall Street chief executive himself, now standing on the opposite side of the table, forced to decide who would be saved and who would not. And Tim Geithner, president of the Federal Reserve Bank of New York, the man in the room where it happened, quite literally, as the decision that would define this crisis was made. Keep these 3 names close, because before this file is closed, all 3 of them will be forced into the same impossible position, choosing, in real time, with the whole financial system watching what history would remember as either the right call or the failure that broke it. But to understand how three men in a room in downtown Manhattan came to hold that kind of power over the fate of a global economy, we have to go back, much further back than you might expect. Not to a boardroom, not to Wall Street at all. We have to go back 158 years to a small fabric shop in Alabama, to the very beginning of a story that ends with cardboard boxes on a New York sidewalk. That is where we start. Chapter 1, an empire of 158 years, from a fabric shop to the throne of Wall Street. Every case file has an origin, a moment before the crime, before the victim even had a name, when everything was still simple, still hopeful, still small enough to hold in two hands. For Lehman Brothers, that moment happened in a town called Montgomery, Alabama, in the year 1850. Picture it, a dusty street in the American South. Wagons, cotton bales stacked outside storefronts. And on one corner, a modest shop with a hand-painted sign above the door, run by a young man named Henry Lehman. Henry was not a banker. He was not a trader. He was a Jewish immigrant from Bavaria, in what is now Germany, who had crossed an ocean with almost nothing, chasing the same promise that pulled millions of others toward American shores. The idea that hard work and a little courage could build something out of nothing. He opened a dry goods store, fabric, thread, household basics, the kind of shop that exists in every small town, run by someone who simply wants to feed his family and keep the lights on. 2 years later, his younger brother Emmanuel arrived from Germany to join him, and in 1858, the youngest of the three Mayer completed the trio: Henry, Emmanuel, and Mayer Lehman. Three brothers, one shop, one name above the door, H. Lehman. It would later become Lehman Brothers. And for 158 years, that name would travel further than any of the three brothers could possibly have imagined, through boardrooms, through stock exchanges, through the pages of history itself. But in 1850, none of that was visible yet. There was only a shop, a shelf of fabric, and three brothers trying to survive. Here is where the story takes its first quiet turn, the kind of turn that, looking back, historians love to underline in red ink because it marks the exact moment a simple retail business began to think like a financial one. In the American South of the 1850s, there was one commodity more valuable than almost anything else on the shelves of Henry Lehman's little store: cotton. Local farmers, many of them cash poor, began paying for their fabric and household goods, not with money, but with raw cotton. At first, this was simply a convenience, a trade of goods for goods. But the Lehman Brothers noticed something the average shopkeeper might have missed. Cotton itself had value, real, tradable, fluctuating value. If you accepted cotton as payment and then sold that cotton to buyers elsewhere, you were no longer just a merchant selling thread and cloth. You were something new. You were a middleman in a much larger, much more powerful trade. The brothers leaned into it. They began accepting cotton more and more readily, storing it, grading it, and selling it onward to buyers across the region and eventually across the country. Slowly, without any grand plan or announcement, Lehman Brothers stopped being a fabric shop that occasionally took cotton as payment and became a cotton brokerage that occasionally still sold fabric. This is the seed. Right here, in a small Alabama storefront, in the space between selling cloth and trading cotton, the very first instinct of financial thinking took root inside the Lehman family. The idea that value could move, that a good could become a contract, that a contract could become a trade, that a trade could become an empire. It was still small. It was still local. But the DNA had changed. The next move came almost naturally, the way a river finds the path of least resistance downhill. As the Lehman Brothers cotton trading business grew, they realized that the center of gravity for American commerce was shifting north to a city where goods, money, and information moved faster than anywhere else on the continent: New York. In 1858, the same year the youngest brother Mayer joined the family firm, Lehman Brothers opened an office in Manhattan. Cotton was still the beating heart of the business, but now it was being traded not from a dusty southern storefront, but from a city that was rapidly becoming the financial capital of the Western Hemisphere. And then came the moment that truly opened the door. In 1887, Lehman Brothers secured a seat on the New York Stock Exchange. Take a moment with that image. Three brothers who began by selling thread and fabric to farmers in Alabama were now standing, quite literally, on the trading floor of the most powerful financial marketplace on the planet. The distance between those 2 points, the fabric shop and the stock exchange floor, is the distance an entire empire would be built upon. From cotton, Lehman Brothers expanded into underwriting the stocks and bonds of other companies. It helped finance railroads, stretching steel across a growing nation. It helped finance department store chains and eventually the airline and oil industries as the 20th century rolled forward. It became one of the founding institutions, helping American businesses raise the capital they needed to grow, not by making anything itself, but by connecting those who had money with those who needed it, and taking a share of the value created in between. By the early 20th century, the little shop in Montgomery was a memory, a footnote, a story told at family dinners. In its place stood a genuine Wall Street institution. And that is where the second act of this chapter begins. Because building an empire is one thing, surviving is another thing entirely. And over the following century, Lehman Brothers would be tested again and again by exactly the kind of crises that end most companies for good. The first great test came almost immediately after the brothers had planted their flag in New York, the American Civil War, tearing through the very region where the firm had been born. Cotton, the commodity that had built the Lehman fortune, was now caught in the crossfire of a nation at war with itself. And yet the firm did not simply survive the war. It adapted, shifting its focus and its geography, coming out the other side, still standing, still trading, still growing. That pattern, crisis, adaptation, survival, would repeat itself decade after decade. Like a heartbeat, the company simply refused to stop. In 1929, the stock market of the United States collapsed in a matter of days, wiping out fortunes overnight and plunging the country into the Great Depression. Banks failed by the thousands. Household names in finance disappeared entirely, swallowed by panic and bad debt. Lehman Brothers did not disappear. It weathered the storm, scaled back where it had to, and lived to see the recovery on the other side. Just over a decade later, the entire world was consumed by the Second World War. Economies mobilized for combat, capital markets frozen or redirected toward the war effort, an entire generation of business sent overseas or into uncertainty. Lehman Brothers survived that too. In the 1970s, an oil crisis sent shockwaves through global markets, driving prices to unprecedented levels and triggering a period of economic stagnation that punished companies across nearly every industry. Lehman Brothers survived that as well. And in October of 1987, on a single trading day that would come to be known as Black Monday, stock markets around the world crashed with a speed and violence that stunned even seasoned traders, the Dow Jones Industrial Average losing more than 20% of its value in a matter of hours. Once again, Lehman Brothers stood back up. Civil War, global depression, World War, oil crisis, market crash. 5 separate moments in American and world history, each one powerful enough to have ended a lesser institution, and each one absorbed, survived, and eventually turned into another chapter of the Lehman legend. By the time the 20th century was drawing to a close, this survival record had become more than a matter of historical fact. It had become a story the company told about itself, an identity, a kind of internal mythology passed down through generations of Lehman employees, whether or not they were related to the founding family by blood. The culture inside Lehman Brothers, especially in its later decades, was famously tight-knit, almost tribal in its intensity. Employees described a workplace built on a simple, almost military code, one for all and all for one. Loyalty to the firm was not simply expected, it was worn like a badge of honor. Internal rivalries with competing banks were treated less like ordinary business competition and more like something closer to warfare, with Lehman employees rallying around their firm the way soldiers rally around a flag. This closed, fiercely loyal culture had genuine strengths. It bred discipline. It bred a willingness to work punishing hours in pursuit of a shared goal. It created an institution where employees felt they belonged to something larger and older than themselves. An empire with roots stretching back to a fabric shop in Alabama, a firm that had outlived wars and depressions and crashes that had destroyed nearly everyone else. But hold on to that description for a moment. Remember it, because a culture built entirely on internal loyalty, on the unshakable belief that we always survive, can also become something far more dangerous. It can become a culture that struggles to hear warnings from the outside. A culture where dissent feels like disloyalty. A culture where the very story that makes a company feel invincible is the same story that makes it blind to the one crisis it was never designed to survive. We will return to that idea. But first, one more turn in the story. The turn that brings us to the edge of the crisis at the heart of this entire file. In 1994, Lehman Brothers, which had spent a period as part of the financial services giant American Express, was spun off once again as an independent, publicly traded company. And at the helm of this newly independent Lehman stood a man who would come to define its final chapter more completely than any other single figure in its 158-year history. His name was Richard Fuld, Dick Fuld, to almost everyone who knew him. Under Fuld's leadership, Lehman Brothers transformed itself once again, this time into one of the most aggressive, most ambitious investment banks on all of Wall Street. Where earlier generations of Lehman leadership had built the firm's fortune on underwriting stocks, bonds, and steady corporate finance work, Fuld's Lehman pushed harder, took on more risk, and chased faster, larger returns. And nowhere was that appetite more visible than in one particular corner of the financial world: real estate. As the American housing market began its historic climb through the late 1990s and into the 2000s, Lehman Brothers didn't simply participate in that boom. It leaned into it with everything it had, becoming one of the largest players in an increasingly complex, increasingly opaque financial practice, a practice that took ordinary home mortgages and transformed them into tradable securities that could be bought, sold, and packaged in ways almost no one outside a small circle of specialists fully understood. We will spend an entire chapter unpacking exactly how that machine worked and why it would ultimately prove so dangerous. For now, simply understand this. By placing enormous bets on real estate and on this new wave of mortgage-based financial engineering, Lehman Brothers was making a decision that would define, more than any other single choice in its long history, whether the empire would survive into a second century or not. For a long time, it looked like the bet was paying off spectacularly. By 2007, Lehman Brothers stood as the fourth largest investment bank in the United States, trailing only Goldman Sachs, Morgan Stanley, and Merrill Lynch. Its profits were setting company records year after year. Its stock price had climbed to an all-time high, rewarding shareholders and employees alike with the kind of returns that made Wall Street careers and Wall Street reputations. From the outside, it was hard to imagine a company standing on firmer ground. Here was an institution that had survived a civil war, 2 world wars, a depression, an oil crisis, and a market crash. And now, in the 21st century, it appeared to be thriving more than ever, riding at the very top of the global financial system. And that, precisely, is where the danger was hiding, because the very confidence that had allowed Lehman Brothers to survive 158 years of history, the deep, almost mythological belief that this firm always finds a way through, was quietly becoming something else entirely. Not resilience anymore, but blindness. Not survival instinct, but denial. The same story the firm told itself after the Civil War, after the Depression, after the World Wars, after Black Monday. The story of an unbreakable institution was about to be tested by a threat unlike any of the others. Not a war fought with weapons, not a market crash that unfolded in a single violent day, but something slower, quieter, and in many ways far more dangerous. A financial weapon of the firm's own making, built inside its own walls, sold under its own name, and hidden inside numbers that looked, on paper, entirely respectable. It had a name that, in 2007, meant almost nothing to the average person outside of Wall Street trading floors and ratings agency offices: subprime mortgage-backed securities. In the next chapter, we open that particular file and we begin to understand exactly how a financial invention dressed up to look like safety quietly became the mechanism that would bring an empire of 158 years to its knees. Chapter 2. The magic money machine, the housing bubble, and the collateralized debt obligation game. Every great deception has an origin story that sounds at first like a gift. To understand how Lehman Brothers, and much of the American financial system alongside it, walked willingly into disaster, we have to go back to the early 2000s, to a country still shaken, still grieving, still searching for something solid to hold on to. In September of 2001, the United States suffered the worst terrorist attack in its history. The wound was deep, and it reached into every corner of American life, including its economy. In response, the Federal Reserve, the central bank of the United States, did what central banks do in moments of crisis. It slashed interest rates again and again, pushing the cost of borrowing money down to levels the country had rarely seen. The intention was simple, and in many ways, honorable. Cheap borrowing was meant to encourage spending, encourage investment, and coax a wounded economy back onto its feet. And it worked, perhaps too well. With interest rates near historic lows, borrowing money suddenly became remarkably easy, and nowhere did that easy money flow faster or more eagerly than into one particular corner of the American dream: homeownership. For generations, owning a home had stood at the very center of what it meant to succeed in America. A house with a yard, a mortgage with your name on it, a piece of the country that belonged to you and your family and could be passed down to the next generation. In the early 2000s, with interest rates so low, that dream suddenly felt closer, more reachable, more democratic than ever before. Banks and mortgage lenders across the country began marketing home loans aggressively, not just to families with strong credit and steady incomes, but to people who, under almost any other circumstances, would never have qualified to borrow that kind of money. This is where our invisible villain enters the story. It did not wear a mask. It did not carry a weapon. It arrived wearing a suit, carrying a clipboard, smiling warmly across a kitchen table, promising a family their very first home. It went by a quiet, almost bureaucratic name: the subprime mortgage. In plain terms, a subprime mortgage is a home loan extended to a borrower who does not meet the standard qualifications a bank would normally require: weak credit history, unstable income, little or no savings for a down payment. Under traditional lending standards, these borrowers would have been turned away. But in the early 2000s, lenders found a way to say yes anyway. Loans were approved with minimal documentation. Some borrowers were not even required to prove their income at all. Loans that industry insiders would later almost mockingly nickname liar loans. Interest rates on many of these mortgages were structured to start artificially low for the first 2 or 3 years, before resetting sharply upward later on, a detail buried deep in paperwork that few borrowers ever fully understood, and few lenders ever bothered to explain in plain language. On its own, a risky loan to a single family is a small problem. A tragedy, perhaps, for that one household, but not a threat to the global financial system. The threat came from what happened next, from the invention that took millions of these individual risky loans and transformed them into something that looked, on paper, almost entirely safe. To understand this invention, forget Wall Street for a moment. Picture a kitchen instead. Imagine a company that makes instant noodles. Now imagine that company has a warehouse full of ingredients. Some of that flour is fresh, high quality, exactly what you'd want in your dinner. But some of it, mixed in among the good flour, is old, slightly spoiled, not something you would ever want to eat on its own. A dishonest producer does not sell the spoiled flour by itself. Nobody would buy that. Instead, the producer blends it carefully in small amounts throughout thousands of packets of noodles basted up alongside the good flour. Then, the producer puts a shiny label on the outside: premium quality, certified fresh, and sells the packets by the truckload to buyers who trust the label and never see what's actually mixed in inside. This, in essence, is what Wall Street did with home loans. The financial industry took thousands of individual mortgages, some healthy, some deeply risky, and bundled them together into a single financial product. This bundle was called a mortgage-backed security, or MBS for short. Instead of a bank simply holding a loan and waiting patiently for a family to pay it back over 30 years, that same bank could now bundle the loan together with thousands of others and sell the entire package to investors around the world, collecting a large payment up front and moving the risk off its own books entirely. Then the process went one dangerous step further. Financial engineers took these bundles of mortgages and sliced them into layers based on risk, then repackaged those layers into an even more complex product called a collateralized debt obligation, or CDO. Different layers, or tranches, were sold to different types of investors. The safest sounding layer was marketed as extremely low risk, suitable for conservative investors like pension funds. Riskier layers, mixed with lower quality loans, were sold separately, often to investors chasing higher returns. On paper, this sounded almost elegant. Spread the risk. Slice it thin enough and diversify it widely enough, and surely no single failure could bring the whole structure down. In practice, it meant something much closer to that noodle warehouse. Bad ingredients quietly blended into good ones, repackaged, relabeled, and sold onward to buyers who had no real way of seeing what was actually inside the product they were purchasing. And here's where the deception reached its most dangerous point. Because a label is only as trustworthy as the authority that puts it there. In the world of home cooking, that authority might be a food safety inspector. In the world of Wall Street, that authority belonged to a small handful of powerful institutions known as credit rating agencies. Names like Moody's and Standard & Poor's, commonly known as S&P. These agencies existed, in theory, to protect investors. Their job was to examine complex financial products, like mortgage-backed securities and collateralized debt obligations, and assign them a letter grade, much like a report card indicating how safe or risky they truly were. The highest possible grade, AAA, was meant to signal the absolute safest category of investment, the kind of security a retirement fund, a school district, or a foreign government could purchase with total confidence. Astonishingly, enormous portions of these mortgage bundles, built partly on the shakiest loans in the American housing market, were stamped with that same AAA seal of approval. Why would that happen? Follow the money, and the answer becomes uncomfortably clear. The rating agencies were not paid by the investors they were supposedly protecting. They were paid by the very banks that created these complex financial products in the first place. A bank looking to sell a mortgage bundle would essentially hire a rating agency to grade its own homework. And if one agency's grade came back too harsh, too cautious, the bank could simply take its business to a competing agency, more willing to hand out the label the bank wanted to see. It was, in effect, a conflict of interest hiding in plain sight. The referees of the game were being paid by one of the two teams on the field, with AAA stickers attached to products that, underneath the surface, contained a rising share of subprime risk. The entire machine had what it needed to keep growing. Pension funds, insurance companies, foreign banks, and everyday investment portfolios around the world scooped up these securities, believing in good faith that they were buying something safe. Lehman Brothers did not simply participate in this machine from a distance, quietly trading the products that others had built. Lehman Brothers wanted to control the entire pipeline from beginning to end. Beginning in the early 2000s and accelerating through the middle of the decade, Lehman went on a buying spree, acquiring mortgage lenders directly so that it would no longer need to purchase raw loans from outside companies before packaging them. It bought a company called BNC Mortgage, which specialized in exactly the kind of subprime lending we've just described. It bought another firm, Aurora Loan Services, which extended so-called Alt-A loans, a category sitting just one notch above subprime, but carrying many of the same underlying risks. With these acquisitions, Lehman Brothers had built itself a closed loop. It could originate risky home loans directly, package them into mortgage-backed securities and collateralized debt obligations in-house, ship them off to rating agencies for their AAA seal of approval, and sell the finished product to investors around the world, capturing profit at every single stage of the process. Origination, packaging, rating, distribution, all of it increasingly under one roof. The volume was staggering, and the profits that flowed from this pipeline were, for a time, extraordinary. But there was a hidden cost to running a machine at this scale, and that cost had a name too: leverage. In simple terms, Leverage measures how much a company is borrowing compared to how much of its own money it actually has. A conservative company might borrow modestly against its own capital. An aggressive one borrows heavily, multiplying both its potential gains and its potential losses many times over. By the mid-2000s, Lehman Brothers had pushed its leverage to a staggering ratio of roughly 30 to 1. For every single dollar of real, genuine capital the firm actually possessed, it had borrowed approximately $30 more to fund its trading and investment activities. To put that number in perspective, imagine a family that owns a home worth $100,000 in equity and takes out loans totaling $3 million against that equity, betting the difference on the belief that their investments will only ever go up. As long as prices keep climbing, this kind of leverage can generate breathtaking returns. But the moment prices even pause, let alone fall, that same leverage becomes a weapon pointed directly at the borrower's own survival. This was the true architecture of the machine Lehman Brothers had built for itself, and it mirrored a pattern spreading across much of the global financial system at the time. Not simply risky loans made to risky borrowers, something far larger and more fragile, an inverted pyramid, an entire tower of financial products, profits, and institutional confidence, resting on a foundation designed to hide risk, dilute it, relabel it, and spread it so widely across the globe that almost no one, at any single point in the chain, could see the full shape of the danger they were standing on. Behind every number in this machine, every mortgage bundle, every AAA rating, every trading desk profit, there was somewhere an actual family with an actual name sitting at an actual kitchen table. Picture one of them now. A husband and a wife, perhaps with 2 young children, sitting across from a mortgage broker in a modest home in a suburb somewhere in America. They are not financial experts. They are not reading footnotes about adjustable interest rate resets or asking questions about where their loan will end up 3 steps down a chain none of them have ever heard of. They simply want a home, a yard for their children, a piece of the same dream that had pulled immigrants like Henry Lehman across an ocean more than a century before. The broker smiles and explains the numbers with the confident, practiced ease of someone who has said the same words hundreds of times before. A low monthly payment, at least for now. A rate that is fixed, at least for the first 2 years. The family signs. They have no way of knowing that in exactly 24 months, that same monthly payment will jump sharply upward in a moment their household budget may not be able to absorb. They have no way of knowing that their loan will soon be bundled with thousands of others they will never meet, sliced into layers, stamped with a safety rating paid for by the very bank that sold it to them, and sold onward to investors across the world who believe in good faith that they are buying something secure. That family is not a footnote in this story. They are the seed. Multiply that single kitchen table conversation by millions across cities and suburbs throughout the entire country, and you begin to understand the true scale of what was being built during these years. Not simply a financial product, but a slow-motion human crisis, quietly assembling itself one signature at a time, underneath a financial system that had convinced itself it had found a way to make risk disappear. For a while, the machine simply worked. Home prices climbed, bundled securities performed, bonuses grew fatter on Wall Street with each passing year, and firms like Lehman Brothers reported record profits quarter after quarter, as though the upward climb might simply continue forever. But no pyramid, inverted or otherwise, can defy gravity indefinitely. The entire structure depended on one single, unshakable assumption that home prices in the United States would keep rising year after year without pause. In 2006, that assumption finally broke. Home prices across the United States stopped climbing. In some markets, they began, slowly at first, to fall. And when the magic money machine finally stalled, the very first cracks began to appear, small, quiet, easy to dismiss at first, in exactly the places where almost no one on Wall Street was bothering to look. Chapter 3, The First Cracks, Warning Bells Nobody Wanted to Hear. Every case file has a moment where, looking back, the evidence was already sitting in plain sight. Not hidden, not buried, just ignored by people who had every reason to look away. This chapter is about that moment. Early in 2007, almost a full year after home prices in the United States had quietly stopped climbing, the first visible casualties of the subprime mortgage machine began to appear. Not at the giant banks yet, not at Lehman Brothers or Bear Stearns or Merrill Lynch. The first casualties were smaller, more specialized companies, the ones standing closest to the ground floor of the machine we described in the last chapter, the lenders who actually originated the risky loans in the first place. One name more than any other marked the beginning of the end for this era: New Century Financial. New Century was one of the largest subprime mortgage lenders in the entire United States, a company that had grown explosively during the housing boom by extending exactly the kind of loans we described earlier: loans to borrowers with weak credit, loans with little documentation, loans structured with low introductory rates, designed to reset sharply higher after a year or two. For years, New Century had thrived. Its stock price had climbed. Its loan volume had grown. And then, almost overnight, the machine it depended on began working against it. Borrowers who had taken out those 2-year loans began missing payments in numbers the company hadn't planned for. Defaults climbed. The value of the loans still sitting on New Century's books began to collapse. By April of 2007, New Century Financial filed for bankruptcy. On Wall Street, the reaction was, in hindsight, almost bewilderingly calm. New Century was written off as an outlier, a poorly managed company that had simply been more reckless than its competitors. Analysts and executives across the industry reassured themselves and each other that this was an isolated failure, not a symptom of something larger. The subprime problem, they insisted, was contained. That word, contained, would come back to haunt nearly everyone who used it. 2 months later, in June of 2007, a second, far louder warning bell rang out, this time from a name that could not be dismissed as some small, marginal player: Bear Stearns. Bear Stearns was one of the giants of Wall Street, a firm that, much like Lehman Brothers, had built enormous profits during the housing boom by trading in exactly the kind of mortgage-backed securities and collateralized debt obligations described in the last chapter. Inside Bear Stearns sat 2 hedge funds, investment vehicles managed by the firm, that had bet especially heavily on these products. In June of 2007, both of those hedge funds collapsed virtually overnight as the mortgage securities inside them lost value faster than anyone at the firm had modeled or expected. Investors who had trusted their money to these funds discovered they might recover only a fraction of what they had put in, if anything at all. This was not some obscure subprime lender operating on the margins of the financial system. This was 2 funds run by one of the most respected investment banks in the country, collapsing under the weight of the exact products that AAA ratings had once declared perfectly safe. And yet, once again, the broader market largely shrugged. Bear Stearns' stock dipped, then stabilized. Executives across Wall Street described the collapse as unfortunate but isolated. A bad bet by 2 specific funds, not a warning about the health of the system as a whole. Here is where the case file grows more personal. Because contained within Bear Stearns' collapse and unfolding quietly inside Lehman Brothers at almost the exact same time were individual human beings whose job it was to see exactly this kind of danger coming, and who did. Inside Lehman Brothers, one of those people was a man named Mike Gelband. Gelband ran Lehman's commercial real estate division, one of the areas of the firm most directly exposed to the mortgage machine we described in Chapter 2. And unlike much of the leadership above him, Gelband was, by multiple accounts, growing seriously alarmed. He looked at the deteriorating conditions in the housing market, at the widening cracks appearing at firms like New Century and inside Bear Stearns' hedge funds, and he reached a conclusion that ran directly against the prevailing mood inside Lehman's executive offices. The firm needed to pull back, reduce its exposure to real estate, slow down at exactly the moment when the machine's momentum was strongest and the profits it was still generating were hardest to walk away from. He raised these concerns internally through the normal channels available to a senior executive at a major investment bank: meetings, memos, direct conversations with leadership above him. His warnings did not land the way one might hope. Rather than triggering a broader reassessment of risk at the highest levels of the firm, Gelban found himself increasingly sidelined. Later that year, he would be pushed out of his role entirely. Gelban was not the only voice inside Lehman raising concerns during this period, and this pattern, a risk manager or senior executive flagging danger only to be marginalized, reassigned, or removed, is one of the most consistent threads running through the entire story of Lehman's final years. The firm did not lack people capable of seeing the danger. What it lacked was a culture willing to listen to them. And to understand why, we have to return to the two men sitting at the very top of Lehman Brothers during this period: Chief Executive Dick Fuld and his closest deputy, a man named Joe Gregory. By 2007, Fuld and Gregory had led Lehman Brothers together for well over a decade, and over those years, they had built something closer to a fortress of loyalty around themselves than a conventional corporate leadership structure. Executives who consistently challenged the prevailing strategy tended not to last long in their positions. Executives who supported the aggressive push deeper into real estate, deeper into mortgage securities, deeper into leverage, tended to rise. This was not simply an accident of personality. It was, in a very real sense, the natural endpoint of the culture we described in Chapter 1, the fierce tribal loyalty, the one-for-all, all-for-one mentality that had once helped Lehman Brothers survive a civil war, a depression, and 2 world wars. That same culture, turned inward at exactly the wrong moment, made internal dissent feel less like responsible risk management and more like betrayal. So, faced with early tremors across the mortgage industry throughout 2007, Lehman's leadership did not choose to retreat. They chose to advance. Rather than scaling back its exposure to real estate and mortgage securities, as warning signs accumulated around the industry, Lehman Brothers, under Fuld and Gregory, continued expanding its bets throughout the second half of 2007 and into early 2008. In the eyes of the firm's leadership, this looked less like recklessness and more like opportunity. Competitors were pulling back. Prices on certain real estate assets were falling. To Fuld, a man who had spent his entire career believing in his own instincts and in his firm's unmatched ability to weather any storm, this looked like exactly the moment to lean in harder, to buy while others were selling, to prove once again that Lehman Brothers did not simply survive crises. It emerged from them stronger than before. It was the same story the firm had told about itself for 157 years, applied this time to a threat that did not behave like any of the others. The moment that shattered any remaining illusion that this crisis might stay contained arrived in March of 2008. Bear Stearns, the same firm whose hedge funds had collapsed the previous summer, found itself suddenly, catastrophically, out of cash. In the span of just a few days, rumors about the firm's stability triggered a full-blown run as clients, lenders, and trading partners rushed to pull their money and their business away from Bear Stearns, fearing the firm might not be able to meet its obligations. The exact mechanism, a sudden collapse in confidence, triggering a self-fulfilling spiral of withdrawal, would repeat itself in a far larger and more consequential form at Lehman Brothers just 6 months later. But at this stage, it was Bear Stearns living through it first. With Bear Stearns on the verge of collapse and fears mounting that its failure could trigger a much wider financial panic, the Federal Reserve stepped in. Rather than allowing Bear Stearns to fail outright, the Fed orchestrated an emergency sale of the firm to J.P. Morgan Chase, backing the deal with its own financial guarantees to make the transaction possible. The price of that sale became almost instantly one of the most jarring numbers in the entire financial crisis. Bear Stearns, a firm that had been trading at over $150 per share barely a year earlier, was initially sold for just $2 per share. The price was later raised slightly to $10 per share, following pressure from shareholders. But even at that adjusted figure, it represented a staggering collapse in value for a firm that had only months before been considered one of the giants of Wall Street. The message sent by this deal rippled through every trading floor in the financial world, and it carried 2 very different implications at once. On one hand, it demonstrated that the government was, in fact, willing to intervene to prevent a major Wall Street collapse, at least in some circumstances, using its financial power to broker a rescue rather than allow total failure. On the other hand, it demonstrated something far more unsettling, that a firm as large, as storied, and as seemingly stable as Bear Stearns could go from stable to essentially worthless in a matter of days. Across Wall Street, one question began circulating with growing urgency, whispered in trading rooms, debated in research notes, and increasingly asked out loud by journalists and investors alike. If Bear Stearns could fall that fast, who was next? And almost immediately, one name rose to the top of that list, more consistently than any other. Lehman Brothers. The reasoning was not complicated. Lehman shared many of the same characteristics that had made Bear Stearns vulnerable. A heavy concentration in real estate and mortgage-related securities, extraordinarily high leverage, the same roughly 30-to-1 ratio described in the previous chapter, meaning a relatively small decline in asset values could wipe out a disproportionately large share of the firm's actual capital. And a business model built on borrowing large sums of short-term money, again and again, to fund longer-term investments, a model that depends entirely on lenders and trading partners, continuing to trust the firm enough to keep extending that credit. Faced with this rising wave of scrutiny and speculation, Lehman Brothers leadership responded the way institutions under siege often do: publicly, forcefully, and with total confidence. In the weeks following Bear Stearns' collapse, Lehman executives moved quickly to reassure the market. The firm held conference calls with investors and analysts, emphasizing its liquidity position, the pool of readily available cash and assets it maintained, specifically to reassure lenders and trading partners' obligations, even a moment of stress. It organized briefings for the financial press, presenting detailed figures intended to demonstrate that Lehman Brothers was fundamentally different from Bear Stearns. Better capitalized, better managed, simply not vulnerable to the same kind of collapse. On the surface, at least for a while, this campaign appeared to work. Lehman's stock, while shaken, did not collapse in the immediate aftermath of the Bear Stearns rescue. But behind the scenes, away from the conference calls and the reassuring press briefings, a very different kind of activity was quietly accelerating. A growing number of investors, particularly hedge fund managers who specialized in identifying exactly this kind of vulnerability, began placing bets against Lehman Brothers stock, a practice known as short selling. In simple terms, these investors were betting that Lehman's share price would fall, positioning themselves to profit handsomely if the firm's fortunes continued to deteriorate. This was more than simple financial speculation. It represented the opening moves of what would become, over the following months, an increasingly aggressive hunt as sophisticated investors across Wall Street searched for the next weak link in the chain, the next domino positioned to fall, the next firm whose public reassurances did not quite match the reality sitting underneath its balance sheet. And increasingly, that search kept arriving at the same address, 745 7th Avenue. Inside that building, standing at the very center of the storm, now gathering around his firm's name, was a man who had spent 14 years building a reputation as one of the most formidable, most combative leaders on all of Wall Street, a man whose entire career, whose entire identity, was built on the belief that he did not lose, that his firm did not lose, that whatever storm was forming outside Lehman Brothers under his leadership would do exactly what it had always done for 158 years: stand its ground, absorb the blow, and come out the other side standing taller than before. His name was Dick Fuld, and in the next chapter, we open the file on him directly. Chapter 4, Dick Fuld, the Gorilla of Wall Street. Every case file eventually arrives at a single name, a person whose decisions, whose instincts, whose blind spots matter more than almost anyone else's in the entire story. For the fall of Lehman Brothers, that name is Dick Fuld. To understand what happened inside 745 7th Avenue in September of 2008, we first have to understand the man who had run that building and the firm inside it for the better part of 2 decades. Not simply what he did, but why he believed, right up until the very end, that he was right to do it. Richard Severin Fuld Jr. joined Lehman Brothers in 1969 while he was still a student, not as a senior banker with a corner office and a polished resume, but as an intern, working his way onto a trading floor filled with older, harder, more experienced men in an era of Wall Street that had far less patience for young people who couldn't keep up. He found his footing in a corner of the business that most outsiders would consider almost invisible: commercial paper trading. In plain terms, commercial paper is a form of short-term debt that large corporations use to cover their immediate cash needs, borrowed and repaid, often within a matter of days or weeks. It is not a glamorous corner of finance. There are no headlines written about commercial paper, but it is a business built entirely on speed, nerve, and instinct, where a trader has to read shifting market conditions in real time, and make fast, often irreversible decisions with real money on the line over and over again, all day, every day. It was in many ways the perfect training ground for the kind of leader Fuld would eventually become. By the 1970s and into the 1980s, Fuld had built a reputation inside Lehman Brothers as someone almost uniquely suited to this pressure, calm under fire in a way that unnerved people who didn't know him well, aggressive without hesitation, and almost entirely unbothered by being disliked so long as he was proven right in the end. Colleagues and rivals alike over the following decades would eventually settle on the nickname that came to define him across all of Wall Street: the gorilla. It was not a term of casual affection. It described a leadership style built on intimidation as much as intelligence, a man who treated negotiations, competitors, and even internal disagreements less like ordinary business challenges and more like confrontations to be won, decisively, every single time. Fuld did not appear to see the financial markets as a complex shared ecosystem to be navigated carefully. He appeared to see them as a battlefield. And on a battlefield, in Fuld's apparent worldview, there is no such thing as a draw. There is only winning or losing. This mindset would carry him through one of the defining moments of his early career, 1984, and what insiders would later describe only half-jokingly as an internal coup. At the time, Lehman Brothers was being torn apart from within by a bitter, increasingly public rivalry between its investment bankers, the executives who advised corporations on deals and raised capital for clients, and its traders, the executives like Fuld, who bought and sold securities directly in the markets. The conflict grew so severe, so damaging to the firm's culture and its ability to function, that Lehman Brothers was ultimately sold to American Express, folded into the much larger financial services conglomerate in an effort to escape the internal chaos altogether. Fuld, who had by this point risen into a senior leadership position, was one of the key figures who helped push the traders' faction into control during this period of internal warfare, cementing the trading, risk-taking culture that would go on to define Lehman Brothers for the rest of its independent existence. For a decade, Lehman Brothers existed inside American Express, a subsidiary of a much larger company, its identity somewhat diluted, its independence gone. Then, in 1994, American Express spun Lehman Brothers back out as its own publicly traded company once again. And when Lehman Brothers relaunched onto the New York Stock Exchange as an independent firm, it was Dick Fuld who stood at the very top of it as chief executive officer. He would hold that position without interruption for the next 14 years. 14 years is an extraordinarily long tenure for a chief executive at any major Wall Street institution, an industry famous for high turnover, short attention spans, and boards of directors quick to replace leadership at the first sign of underperformance. Fuld's survival across all 14 of those years was not an accident. It was the direct result of results. Under his leadership, Lehman Brothers' stock price climbed by more than 600%, transforming the firm from a recently independent company still finding its footing into one of the most consistently profitable investment banks on all of Wall Street. Now pause here and consider what 14 years of that kind of success does to a person's psychology. Imagine for a moment that every major decision you have made for over a decade has been validated again and again by rising stock prices, record profits, admiring headlines, and a board of directors that has never seriously challenged your authority. Imagine that every instinct you've followed, every risk you've taken, Every internal critic you've overruled has, in hindsight, appeared to be correct. What would that do to your confidence in your own judgment? For Dick Fuld, the answer appears to have been almost total. By the middle of the 2000s, multiple accounts from people who worked closely with him describe a man who had come to trust his own instincts and the internal risk models built largely around his own philosophy, with something approaching absolute certainty. 14 years without a single year forcing him to seriously reconsider his fundamental approach to running the firm had, understandably, hardened a strength into something closer to a vulnerability. Confidence had calcified into something the case file must now call by its proper name: certainty that no longer checked itself against outside evidence. And Fuld did not operate entirely alone at the top of this structure. Beside him, for much of this period, stood a man whose influence over Lehman's fate would prove nearly as consequential as Fuld's own: Joe Gregory, Lehman's president and chief operating officer and Fuld's closest, most trusted deputy. The relationship between the two men had deep roots, stretching back decades to their earliest years together on Lehman's trading floors. Over time, Gregory became something more than simply a senior executive reporting to the chief executive. He became, by many accounts, Fuld's primary filter, the person through whom much of the information, the personnel decisions, and the internal culture of the firm's leadership passed. This kind of closeness can be a genuine asset in a large organization, a trusted partnership built on years of shared experience. But it also carries a specific, well-documented danger, one familiar to psychologists who study leadership and decision-making far beyond the world of finance: the echo chamber. When a leader surrounds himself with one deeply trusted voice, and that voice largely agrees with, reinforces, and amplifies the leader's own instincts, dissenting information from elsewhere in the organization has to travel further and survive more resistance before it can ever reach the top. By multiple accounts from inside Lehman Brothers during this period, Joe Gregory functioned in practice as exactly this kind of filter. He was closely associated with the firm's continued aggressive push deeper into real estate and mortgage-related securities throughout 2006 and 2007, even as warning signs, like the ones we examined in the previous chapter, began accumulating across the industry. And he played a significant role in personnel decisions during this period, decisions that, intentionally or not, tended to elevate executives who supported the prevailing strategy, while sidelining or removing those like Mike Gelband, who raised serious concerns about the firm's mounting exposure. The result was a leadership structure at the very top of Lehman Brothers that had grown by 2007 and 2008, remarkably insulated from internal challenge. Not because Fuld and Gregory were incompetent men. By every account, both were highly intelligent, deeply experienced financial professionals who had spent their entire careers inside this industry. But intelligence and experience are not, by themselves, a defense against an echo chamber. In some cases, they can make the walls of that chamber even harder to see from the inside. This insulated confidence became most visible and most consequential in how Fuld responded to a series of opportunities during 2008 that, in hindsight, might have allowed Lehman Brothers to avoid its ultimate fate entirely. Throughout the first half of 2008, as Lehman's stock price came under increasing pressure and outside scrutiny intensified following Bear Stearns' collapse, multiple potential investors and acquirers approached the firm, exploring the possibility of injecting fresh capital or even purchasing significant stakes in the company outright. According to numerous accounts from people involved in these discussions, Fuld repeatedly resisted deals that would have required him to accept prices he considered insulting relative to what he believed Lehman Brothers was genuinely worth. To Fuld, a man who had spent 14 years watching his own judgment about the firm's value be repeatedly validated by the market, these lower offers were not seen as realistic reflections of a deteriorating situation. They were seen as opportunistic, predatory attempts to buy a great American institution at a fire sale discount, taking advantage of temporary market panic rather than reflecting Lehman's true underlying strength. This is perhaps the single most tragic thread running through this entire chapter of the case file. Because the very qualities that had made Dick Fuld successful for 14 consecutive years, qualities the case file has already documented in detail: toughness, unshakable self-belief, an almost pathological refusal to accept defeat, had not disappeared as the crisis intensified throughout 2008. If anything, they had grown stronger, sharpened by years of validation. The tragedy is that a genuine existential crisis requires precisely the opposite set of instincts to survive. It requires flexibility instead of rigidity. It requires humility instead of certainty. It requires a willingness to accept a painful, humbling deal today in order to survive to fight another day, rather than holding out for full vindication that may simply never arrive. Dick Fuld, by virtually every account from those closest to him during this period, could not make that pivot. The same instincts that had once saved him, saved his firm, and built a 14-year, 600% rise in shareholder value, had, by 2008, become something closer to a fatal blind spot. A man who had never lost, standing at the edge of the one battle where refusing to lose gracefully would guarantee the far larger loss. History would eventually force him to answer for this in front of the entire country. In the years following Lehman's collapse, Dick Fuld would be summoned before Congress, called to testify in front of committees investigating the causes of the broader financial crisis. Picture the image for a moment. A man once celebrated across Wall Street as a financial genius, a legendary trader who had built one of the most storied turnarounds in the history of American finance, now sitting at a witness table facing pointed, often hostile questioning from elected officials in front of television cameras broadcasting to the entire nation. The gorilla of Wall Street questioned publicly, methodically, about exactly how his empire had fallen. But that day was still in the future. Before Dick Fuld would ever sit at that witness table, there was one more chapter he had to live through first. One more summer, the final summer before the end, when every remaining door that might have saved Lehman Brothers would, one by one, quietly begin to close. Chapter 5, The Deadly Summer of 2008, Doors Slamming Shut. Every case file has a season where the outcome is not yet decided, but the odds have already begun turning quietly, irreversibly, against the person at the center of the story. For Lehman Brothers, that season was the summer of 2008. By this point in our file, we already know the shape of the danger. We know about the mortgage machine built and run at extraordinary scale inside Lehman's own walls. We know about the leverage, roughly $30 borrowed for every single dollar of real capital. We know about the warnings raised and dismissed, and about the man at the top, Dick Fuld, whose 14 years of unbroken success had hardened into a certainty that would not bend. Now, watch what happens when all three of those forces collide with a single earnings report. In June of 2008, Lehman Brothers announced its results for the second quarter of the year, and for the first time since the firm's initial public offering back in 1994, the number at the bottom of the page was not a profit. It was a loss. $2.8 billion, gone in a single quarter. Understand what this number meant, both financially and psychologically. Financially, it confirmed in the plainest possible terms that the mortgage-related assets sitting on Lehman's books were worth significantly less than the firm had been telling the market, and perhaps less than the firm had been telling itself. Psychologically, it shattered something even more fragile than a balance sheet. 14 straight years of an unbroken track record, the very foundation of Dick Fuld's identity and of the market's trust in him. Lehman's stock price, which had already been sliding for months under the pressure we described in Chapter 3, began falling in earnest. Investors who had given the firm the benefit of the doubt throughout the Bear Stearns turmoil now had a concrete, audited number confirming their worst suspicions. And in financial markets, once doubt turns into confirmed bad news, it rarely moves quietly. It moves like a crowd finding the exits all at once. Into this widening crack stepped one of the most consequential critics in the entire story, a hedge fund manager named David Einhorn. Einhorn ran a fund called Greenlight Capital, and months before Lehman's second quarter loss became public, he had already built a substantial short position against Lehman's stock, betting with real money that the firm's share price would fall. But Einhorn did something that set him apart from the many other investors quietly betting against Lehman during this period. He went public with his reasoning, delivering a widely covered speech and speaking openly to financial media, laying out in detail why he believed Lehman's accounting for its mortgage-related assets was, in his words, not simply optimistic, but misleading. Einhorn's argument was methodical, not emotional. He pointed to the gap between how Lehman valued certain troubled assets on its books and what those same assets appeared to be worth based on where similar securities were actually trading in the market. He argued that Lehman was, in effect, marking down its losses far more slowly and far more gently than reality demanded, presenting a picture of financial health to investors that did not match the underlying condition of the firm. Lehman Brothers pushed back forcefully and publicly against Einhorn's accusations, insisting its accounting practices were sound and thoroughly reviewed. But the damage to confidence was already spreading, independent of who was ultimately correct. Once a respected, outspoken investor accuses a major Wall Street firm of hiding losses, and once that firm's own earnings report reveals a multi-billion-dollar loss shortly afterward, the market does not wait patiently for a final verdict. It simply starts pricing in the worst case and moving its money elsewhere. Inside 745 7th Avenue, this mounting external pressure collided violently with internal turmoil. Aaron Callan, Lehman's chief financial officer, had become, over the previous year, one of the most visible faces of the firm to the outside world, frequently appearing on financial television and in interviews to reassure investors about Lehman's stability, much like the campaign we described at the end of Chapter 3. Following the disastrous second quarter results and amid growing questions about how the firm's financial position had been communicated to the market, Callan was forced to step down from her role. Days later, an even more significant figure fell. Joe Gregory, Fuld's longtime president, closest deputy, and the man we identified in the previous chapter as the primary architect of Lehman's echo chamber, was pushed out of the firm entirely, in an emergency leadership shakeup meant to signal to a panicking market that Lehman Brothers was finally, seriously, addressing its problems. Pause here and consider the timing. Joe Gregory, whose closeness to Fuld and whose role in sidelining internal critics we examined at length in Chapter 4, was removed only after the crisis had already become undeniable, only after a multi-billion-dollar loss had already been reported, only after an outside investor had already gone public with detailed accusations. The very reforms that might have changed Lehman's trajectory had they happened 18 months earlier, when Mike Gelband and others were first raising warnings, were now arriving in the summer of 2008, at a moment when they read less like proactive correction and more like a captain finally throwing cargo overboard as the ship was already taking on water. It was, in the language of this case file, too little, arriving far too late. With its own capital position deteriorating and its credibility under sustained public attack, Lehman Brothers now needed something urgent, something concrete, something the market could point to as genuine proof that the firm was not simply managing a slow decline, but actually solving its underlying problem. It needed a large infusion of fresh capital from an outside investor with deep enough pockets to make a real difference. And through the summer of 2008, one name rose to the top of Lehman's list of potential saviors: the Korea Development Bank, a major state-run financial institution based in South Korea, commonly known by its initials KDB. The logic behind the pursuit was straightforward. Korea Development Bank had the scale and the financial capacity to inject billions of dollars into Lehman Brothers in exchange for a significant equity stake, potentially solving the firm's capital crisis in a single decisive transaction. For Lehman's leadership, and for Dick Fuld in particular, a deal with KDB represented something close to a lifeline, a chance to raise the capital the firm desperately needed, without being forced into a full sale of the company, and without having to accept the kind of humiliating fire sale valuation that Fuld, as we saw in the previous chapter, had already rejected from other potential suitors earlier in the year. Negotiations between Lehman Brothers and Korea Development Bank stretched on for weeks through the late summer, conducted largely out of public view, but increasingly the subject of intense speculation across financial media as investors and analysts tried to read every scrap of information about how the talks were progressing. The core sticking point, as it so often is in negotiations of this scale, came down to two interlocking questions. How much was Lehman Brothers actually worth, and how much ownership and control would KDB receive in exchange for its investment? Lehman's leadership, still operating under the belief that the firm's underlying value remained far higher than its battered stock price suggested, pushed for terms that reflected that higher valuation. Korea Development Bank, looking at the same mortgage-related assets that David Einhorn had already publicly questioned, and watching Lehman stock continue sliding week after week, pushed back, seeking a larger stake and more protective terms, in exchange for taking on what was clearly becoming a riskier and riskier investment. Neither side was willing to fully yield, and as the days passed, the negotiating window was narrowing far faster than either side seemed to fully appreciate. Then, on September the 9th, 2008, the talks collapsed entirely. Korea Development Bank formally withdrew from negotiations, unwilling to move any closer to Lehman's price expectations, unwilling to absorb the risk sitting on Lehman's books at a valuation Lehman's leadership was prepared to accept. News of the collapse talks did not stay contained for long. Within hours, word had reached the market, and the reaction was immediate and brutal. Lehman Brothers' stock price fell 45% in a single trading session. 45% in one day. Try to sit with the scale of that number for a moment. It is the kind of single-day collapse that, under ordinary circumstances, might define an entire company's history. For Lehman Brothers, in September of 2008, it was simply the latest and most severe in a summer-long series of doors slamming shut, one after another, each one narrowing the path forward just a little further. Behind the scenes, away from the headline stock price, the practical consequences of this collapsing confidence were spreading through every corner of Lehman's operations in ways that mattered just as much as the number on the ticker. Employees who had spent years, sometimes decades, building their careers and their personal savings inside the firm began quietly moving their own money elsewhere, worried, with good reason, about what might happen to accounts and investments tied too closely to Lehman's fate. Trading partners across Wall Street, the banks and institutions that did business with Lehman every single day, extending it short-term credit, engaging in overnight lending arrangements, began demanding additional collateral before continuing to transact with the firm, a form of self-protection that, ironically, only accelerated the strain on Lehman's already stretched resources. And other major banks, watching the same headlines everyone else was watching, began quietly reducing the credit lines they had traditionally extended to Lehman, tightening the flow of the short-term borrowing the firm depended on to function day to day. Each of these actions, taken individually, was a rational, defensive choice made by an institution or an individual protecting their own interests. But taken together across dozens of counterparties simultaneously, they formed something far more dangerous: the early architecture of exactly the kind of run that had destroyed Bear Stearns in a matter of days, back in March. A firm that depends on constant short-term trust from its lenders and trading partners cannot survive if that trust erodes fast enough, regardless of how solvent it might claim to be on paper. And it was not only Wall Street that was watching this unfold with growing alarm. In Washington, two men in particular had been tracking Lehman Brothers' deteriorating situation with increasing seriousness throughout the summer, aware that the firm's fate might soon become a matter of national and even global economic consequence. Hank Paulson, the Secretary of the Treasury of the United States, a man who had spent decades on Wall Street himself before entering public service, understood better than almost anyone in government exactly what a Lehman Brothers failure could mean for the broader financial system. And Tim Geithner, president of the Federal Reserve Bank of New York, sitting at the very center of the American financial system's plumbing, watching the tightening credit lines, the collateral demands, and the collapsing negotiations with Korea Development Bank, with the particular kind of quiet concern reserved for officials who can see a crisis accelerating before most of the public has fully registered its shape. Throughout the final weeks of that deadly summer, both men had begun holding increasingly frequent conversations, both with each other and with senior leaders across the largest banks on Wall Street, about what might need to happen if Lehman Brothers could not find a solution on its own. By early September, with the Korea Development Bank deal in ruins and Lehman's stock in free fall, it had become clear to almost everyone paying close attention that time was no longer measured in months or even weeks. It was measured in days. And in a particular building in downtown Manhattan, a building whose name would become permanently linked to this entire crisis, preparations were already quietly underway for a meeting unlike anything Wall Street had ever seen before. A meeting where the fate of a 158-year-old institution, and quite possibly the stability of the global financial system itself, would be decided not gradually over months of careful negotiation, but across a single sleepless, high-stakes weekend. That meeting is where our file goes next. Chapter 6, The Fateful Thursday. The run begins. From this point forward in the file, we are going to change the way we tell time. Up until now, we have moved in months, in quarters, and seasons. A summer here, a collapse negotiation there. But what happened next unfolded on a different scale entirely. Hours, sometimes minutes. The 24 hours promised in the very title of this story begin now, on a single Thursday in September of 2008. Thursday, September the 11th. Sit with that date for a moment, because the people living through it that year could not avoid sitting with it either. Exactly 7 years earlier to the day, the United States had suffered the worst terrorist attack in its history. A wound that had reshaped American life, American security, and, as we saw in Chapter 2, even American interest rate policy in ways that eventually helped inflate the very housing bubble now collapsing beneath Lehman Brothers. Nobody inside Lehman Brothers, or inside the Federal Reserve, or inside the Treasury Department needed to be reminded of the significance of that date. It hung over the day like a low, uncomfortable pressure, a coincidence too pointed to ignore, even amid a crisis that had nothing directly to do with terrorism at all. 7 years earlier, on this exact date, New York had watched towers fall. Now, 7 years later, on this exact date, New York was about to watch something else collapse. Slower, quieter, but in its own way, just as consequential to the lives of millions of people who would never set foot near Wall Street. Lehman Brothers leadership understood with total clarity by this point that the firm was standing at the edge of a cliff. The collapse of the Korea Development Bank negotiations 2 days earlier, detailed in the previous chapter, had already triggered a 45% single-day plunge in the stock price. Confidence, the single most fragile and most essential currency on Wall Street, was draining out of the firm by the hour. So on this Thursday morning, Lehman Brothers moved to try one more time to stop the bleeding. The firm announced an emergency restructuring plan, unveiled publicly in an effort to reassure a market that had, by this point, heard nearly a year's worth of similar reassurances. The plan centered on two main pillars. First, Lehman would spin off the majority of its troubled commercial real estate assets, the very category of holdings that had ballooned so aggressively under the firm's push into property in the years leading up to the crisis, into a separate entity, an attempt to wall off the most toxic portion of its balance sheet from the healthier parts of the business. Second, the firm announced it was actively pursuing outside capital, seeking a new strategic investor to replace the Korea Development Bank deal that had just collapsed, and reassuring the market that discussions with other potential partners remained ongoing. On paper, and read in isolation, this was a serious, structurally sound response to a serious problem. Separate the bad assets, find fresh capital, buy time to stabilize. But by September of 2008, Lehman Brothers had a problem that no restructuring announcement, however well designed, could fully solve. The market had simply stopped believing what the firm told it. This is worth pausing on because it represents one of the most important and most brutal truths about how a modern financial institution actually survives or dies. A bank like Lehman Brothers does not fail the way an ordinary company fails. through years of declining sales or shrinking market share. A bank like Lehman Brothers fails the moment enough people simultaneously stop trusting it enough to keep doing business with it. And by this point in the story, after the second quarter loss described in Chapter 5, after David Einhorn's public accusations, after the forced departures of Aaron Callan and Joe Gregory, after the collapsed Korea Development Bank talks, that trust had been worn down through so many individual blows that a single restructuring announcement, however sensible on paper, was simply not enough to rebuild it. The market's verdict arrived within hours. Lehman Brothers stock fell another 40% on this single Thursday, adding to the destruction already inflicted just 2 days earlier. Combine the two events, and in less than a week, Lehman's market value, the total worth of the company as measured by its share price, had shrunk to a small fraction of what it had been at its peak. A peak that, as we noted back in Chapter 1, had only been reached a little over a year earlier. But the falling stock price, dramatic as it was not actually the most dangerous thing happening to Lehman Brothers on this particular Thursday. The real danger, the kind of danger that can kill a financial institution in a matter of hours rather than months, was happening away from the ticker entirely, inside a much less visible corner of the financial system. To understand it, we need to introduce one more piece of financial machinery, quickly and in plain terms: the overnight repo market. Large financial institutions like Lehman Brothers do not simply keep vast piles of cash sitting idle to fund their daily operations. Instead, they rely constantly on short-term borrowing, often literally overnight, using their own securities as collateral to keep enough cash flowing through the firm to meet its obligations each day. This overnight borrowing, known as the repo market, functions almost like a financial institution's daily bloodstream, a constant repeating cycle of borrowing and repaying that has to keep circulating hour after hour, day after day, for the institution to remain functional. On this Thursday, and increasingly over the following days, that bloodstream began to seize up. Picture it as a kind of silent, coordinated retreat, though it was not actually coordinated at all, simply the accumulated result of many separate institutions reaching the same conclusion independently, at roughly the same time. Hedge funds that had long done business with Lehman Brothers began pulling their assets and their trading relationships elsewhere, unwilling to leave money exposed to a firm whose stock had just fallen 85% across 2 catastrophic trading days. Other major banks, the very institutions that had, until recently, routinely extended Lehman the short-term overnight credit it depended on to function, began quietly declining to renew those arrangements, or demanding steep additional collateral before agreeing to continue. None of these individual decisions, taken one at a time, were unreasonable. Each institution was simply protecting its own money, its own shareholders, its own survival, in the face of mounting evidence that Lehman Brothers might be in serious trouble. But multiply that same defensive instinct across dozens of counterparties simultaneously, all reaching for the exit at once, and you get something far more dangerous than any single bad decision: a run. Not the kind of run that happens at a neighborhood bank with customers lining up on a sidewalk to withdraw their savings. A modern, institutional version of the exact same phenomenon, playing out silently, invisibly, through phone calls, trading terminals, and quietly declined credit renewals, all across Wall Street, all within the span of a single day. Inside Lehman Brothers itself, this silent unraveling was becoming impossible to hide from the people working there. By this point, Lehman Brothers employed tens of thousands of people around the world, in London, in Tokyo, in offices scattered across dozens of countries, alongside its headquarters in New York. Many of these employees had spent years, in some cases entire careers, inside a firm whose internal culture, as we described back in Chapter 1, prized fierce, almost tribal loyalty above nearly everything else. For many of them, Lehman Brothers was not simply an employer. It was something closer to an identity, a community, a source of genuine pride. By this Thursday in September, that community was beginning to sense with a growing, unspoken dread that something irreversible was happening. Trading floors that would normally be filled with the ordinary noise of a business day, phones ringing, deals being discussed, numbers being shouted across desks, had, according to multiple later accounts from people who were there, taken on a different quality entirely. Quieter in places, tenser in others. Colleagues exchanging glances that communicated more than words could, in a workplace where nobody yet had official confirmation of exactly how bad the situation had become, but where almost everyone could feel it anyway. One description that would later circulate widely among people who lived through this period inside Lehman's offices captured the mood with particular precision. It felt like walking through a funeral that had not yet been formally announced. The grief was already present in the room. Only the official confirmation was still missing. And in downtown Manhattan at the Federal Reserve Bank of New York, that official confirmation, or at least the recognition that something drastic now had to happen, was arriving in real time. Late on this Thursday, Tim Geithner, president of the Federal Reserve Bank of New York, made a series of urgent phone calls. Not to Lehman Brothers directly, not yet. To the chief executives of the largest banks on Wall Street, the very institutions whose quiet withdrawal from Lehman we just described, JP Morgan Chase, Goldman Sachs, Morgan Stanley, Citigroup, Bank of America, Merrill Lynch, and others. Geithner's message was simple, direct, and for many of the executives receiving it, deeply unusual. He asked them to appear in person the following evening at the Federal Reserve Bank of New York's headquarters. Not a routine meeting, not a scheduled call, an urgent in-person gathering of the most powerful figures in American finance, summoned on short notice to address a situation that, by this point, Geithner and his colleagues in Washington understood could no longer be managed through public statements and restructuring announcements alone. As this Thursday drew to a close, back inside 745 7th Avenue, one particular scene deserves to close this chapter because it captures, more precisely than any single statistic could, exactly what this day had cost. Picture Dick Fuld, alone in his office, high above the trading floors that had, just hours earlier, buzzed with the muffled tension of employees who could sense catastrophe without yet being told its name. The stock had fallen 40% that day alone, on top of the 45% collapse just 2 days before. The restructuring plan, carefully designed and publicly announced that very morning, had failed to move the needle. And now, phone calls were happening, in Washington and inside the Federal Reserve, that Fuld himself was not fully controlling. For 14 years, as we documented at length in Chapter 4, Dick Fuld had operated as the single dominant force determining Lehman Brothers' fate. A man whose instincts had been validated again and again, whose authority inside the firm had gone almost entirely unchallenged. Now, for perhaps the first time in that entire 14-year span, the most consequential decisions about his firm's future were beginning to move outside his office, outside his control, into rooms in Washington and downtown Manhattan where he was not present, made by people who were beginning to treat Lehman Brothers less as an independent institution charting its own course, and more as a patient whose treatment now required outside intervention. That same evening, in Washington, Hank Paulson convened his own emergency meetings inside the Treasury Department, gathering his senior staff to begin working through the range of scenarios that might now be facing them. What could the government do, and what should it do, if Lehman Brothers could not find a private solution on its own within the next several days? Should this crisis be treated the same way Bear Stearns had been treated back in March, with government-backed intervention smoothing the way toward a rescue? Or was this situation, given everything examined across the previous 5 chapters of this file, fundamentally different? Neither Paulson in Washington, nor Geithner in New York, nor Fuld inside his darkened office at 745 7th Avenue could yet know exactly how the coming days would unfold. But all 3 men understood, by the close of this Thursday, that the period for gradual incremental responses had ended. The following evening, Friday, the doors of a particular building in downtown Manhattan at 33 Liberty Street would open to receive a gathering unlike any Wall Street had witnessed in generations. Inside would sit the most powerful men in American finance, summoned on short notice, facing a decision none of them had ever had to make before. They would have exactly 3 days. 3 days to save Lehman Brothers, or 3 days to bury it. Chapter 7. The Secret Room at 33 Liberty Street, Friday evening, September the 12th, 2008. Lower Manhattan, after dark. Most of the city's financial workforce has gone home for the weekend or believes it has. But a very different kind of workday is just beginning, inside a fortress-like limestone building at 33 Liberty Street, a building most Americans have never had reason to think about, the Federal Reserve Bank of New York. One by one, black cars begin arriving, not at the main entrance, but through side doors and underground approaches, carefully chosen to avoid the small cluster of financial journalists who, by this point in the crisis, had learned to watch this particular building closely. Out of those cars step some of the most powerful men in American finance, the chief executives of J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Merrill Lynch, Morgan Stanley, and several others, each one summoned on short notice the previous night by a single phone call from Tim Geithner. Picture the scene inside as these men gather. This is not a boardroom any of them are used to. It belongs to none of their own companies. It belongs to the government, to the institution charged with protecting the stability of the entire American financial system. And every person walking through those side doors understands immediately upon arrival that whatever is about to happen here is unlike any meeting they have ever attended in their careers. The atmosphere in the room, according to numerous accounts given afterward by people who were present, was thick with a very particular kind of tension. These men were not strangers to each other. Many had known each other for decades, moved through the same business schools, the same industry conferences, the same charity galas. In an ordinary week, they might sit across from one another at a negotiating table as rival bidders on a corporate deal, or share a friendly dinner as fellow members of the same small elite fraternity that runs American finance. But this was not an ordinary week, and the relationships in that room on this particular Friday night carried a far more complicated weight. Every single executive present ran an institution that, in some way, competed directly with Lehman Brothers, and every single one of them understood with total clarity the uncomfortable truth sitting at the center of the room. Whatever happened to Lehman Brothers over the following 72 hours could very easily determine whether their own firms survived the year. Tim Geithner and Hank Paulson did not waste time on pleasantries. They laid out the situation for the assembled executives in blunt, unambiguous terms. Lehman Brothers was almost certainly going to fail within days unless a solution was found. And then came the sentence that changed the entire character of this crisis, compared to the one that had unfolded around Bear Stearns just 6 months earlier. There would be no go government money this time. Back in March, as described in Chapter 3, the Federal Reserve had backed the emergency sale of Bear Stearns to J.P. Morgan Chase with its own financial guarantees, effectively using public resources to help make that rescue possible. Now, facing a far larger and more dangerous situation, Paulson and Geithner delivered a very different message. Any solution for Lehman Brothers would have to come from the private sector itself, the banks in this room, their own capital, their own risk. If Wall Street wanted Lehman Brothers saved, Wall Street itself would have to find a way to save it. Sit with the strategic logic behind that decision for a moment, because it explains almost everything that happens for the remainder of this chapter. Paulson, in particular, was acutely conscious of a phrase that had begun circulating in Washington and in financial media throughout that summer: moral hazard. The concern, in plain terms, was this. If the government stepped in to rescue every major Wall Street firm that made reckless bets and then found itself in trouble, it would be sending an unmistakable signal to the entire industry. Take whatever risks you want, because ultimately taxpayers will be there to catch you if you fall. Paulson wanted, very deliberately, to draw a line somewhere, and in the tense, sleepless hours of this particular Friday night, that line appeared to run directly through Lehman Brothers. With that message delivered, the room's attention turned to the only path that remained: finding a private buyer. As the assembled executives absorbed the terms of this new reality, their individual motivations, unspoken but unmistakable to everyone in the room, began to diverge in fascinating and consequential ways. Some of the bankers present had genuine, self-interested reasons to want Lehman Brothers saved, regardless of who ultimately did the saving. A disorderly collapse of a firm as large and as interconnected as Lehman Brothers, they understood, would not stay neatly contained within Lehman's own walls. It could easily trigger exactly the kind of cascading panic across the entire financial system that Paulson and Geithner had spent the summer quietly worrying about. If Lehman Brothers fell in an uncontrolled way, the shockwaves might reach their own trading desks, their own balance sheets, their own firms within days. Others in that same room, according to later accounts, were doing a very different kind of mental math. If Lehman Brothers was truly finished, regardless of what happened in this meeting, then perhaps the smartest strategy was not to rescue a drowning competitor, but to quietly position oneself to benefit from its disappearance. Fewer competitors in certain lucrative trading businesses, an opportunity to hire away some of Lehman's most talented bankers and traders once the firm broke apart. Even, for the boldest and most calculating executives in the room, an opportunity to acquire specific pieces of Lehman's business at a steep discount once bankruptcy made those assets available at fire sale prices. Both instincts, the protective one and the predatory one, existed simultaneously inside that single room at 33 Liberty Street, sometimes inside the very same individual executives, depending on which specific piece of Lehman Brothers they happened to be thinking about at any given moment. Out of this complicated competing mix of motivations, two serious potential buyers for Lehman Brothers as a whole began to emerge over the following hours. The first was Bank of America, led by its chief executive, Ken Lewis. Bank of America had spent the preceding several years aggressively expanding through acquisitions, and Lewis had a well-established reputation for being willing to move decisively on large, transformative deals when opportunity presented itself. The second was Barclays, a major British bank, represented in these discussions by Bob Diamond, the head of its investment banking division. Barclays had long expressed ambitions to expand its presence in the United States, and Lehman Brothers, despite its mounting problems, still possessed exactly the kind of established American trading and investment banking infrastructure that Barclays had been trying to build on its own for years. Both potential buyers moved with real urgency that Friday night. Each dispatched teams of financial analysts, accountants, and risk specialists directly to Lehman's own offices and into makeshift data rooms set up specifically for this purpose, to begin the process known in the industry as due diligence, a detailed, exhaustive examination of exactly what assets and exactly what liabilities actually sat on Lehman Brothers' books. Under ordinary circumstances, due diligence of this scale and complexity, examining an institution holding hundreds of billions of dollars in assets, might reasonably take weeks, even months, to complete properly. These teams had, in effect, a single night, working through the early morning hours, poring over spreadsheets, loan portfolios, and trading positions inside conference rooms lit by fluorescent light, while most of New York City slept. The analysts from both Bank of America and Barclays began arriving at a deeply troubling conclusion, one that echoed and amplified exactly the concerns David Einhorn had raised publicly back in Chapter 5. The hole in Lehman Brothers' balance sheet appeared to be significantly larger than the firm itself had ever publicly disclosed. Specifically, the teams found that Lehman's commercial real estate holdings and its remaining portfolio of subprime and other mortgage-related assets, the very products manufactured through the machine described back in Chapter 2, were being carried on Lehman's books at valuations that bore little resemblance to what those same assets could realistically be sold for in the actual market conditions of September 2008. In plain terms, Lehman Brothers appeared to be worth considerably less and to be sitting on considerably larger potential losses than the numbers in its own official financial statements suggested. For any potential buyer, this discovery raised the single most dangerous question in all of finance. Exactly how much money would need to be set aside on day one after any acquisition simply to absorb losses that Lehman itself did not appear to have fully acknowledged. And beneath that question sat an even more unsettling one, whispered among the visiting analysts as the night wore on. If the hole was this large and this well hidden, what else might still be lurking undiscovered inside a balance sheet this size, given only a single night to examine it? As dawn approached on Saturday, the meeting inside 33 Liberty Street had produced urgency, activity, and a great deal of very expensive overnight labor from some of the sharpest financial minds in the country. What it had not produced as the sun began to rise was a deal. No firm commitment had emerged from either Bank of America or Barclays. Both potential buyers had seen enough inside Lehman's books to understand exactly how serious and exactly how uncertain this transaction would be. And in one particularly consequential subplot developing quietly alongside the main Lehman negotiations, Ken Lewis and his team at Bank of America had begun, almost simultaneously, exploring a very different kind of opportunity. Merrill Lynch, another storied Wall Street investment bank, was itself facing serious, though somewhat less acute, financial pressure of its own, and appeared to Lewis's eyes to represent a cleaner, less legally and financially entangled acquisition target than the increasingly troubling puzzle sitting inside Lehman Brothers' balance sheet. By the early hours of Saturday morning, though it was not yet public, and though negotiations over Lehman Brothers were technically still ongoing, Bank of America's attention had begun, quietly, to drift toward a different prize entirely. Word of the night's events did not stay confined to Lower Manhattan. Across the Atlantic, in London, officials at the Bank of England and Britain's financial regulators had already begun receiving updates about the American discussions unfolding at the Federal Reserve, aware that any deal involving Barclays, a major British institution, would carry significant implications and significant regulatory requirements on their side of the ocean as well. And in Washington, inside the White House itself, senior officials were being briefed through the night on a crisis that had, by this point, grown far beyond a single company's balance sheet problems into something with the potential to reshape the American and quite possibly the global financial system. Everyone now understood the stakes. What almost no one in that exhausted overnight meeting yet understood was exactly how this particular story was going to end. By Saturday morning, as the assembled bankers finally emerged, bleary-eyed from a building that had not stopped moving all night, the field of realistic options for saving Lehman Brothers had narrowed down to just two names: Bank of America and Barclays. But over the following 24 hours, both of those remaining paths were about to collapse, each in its own unexpected, almost cinematic way, leaving the room at 33 Liberty Street, facing a possibility that only days earlier would have seemed almost unthinkable. Chapter 8, The Desperate Auction. Bank of America and Barclays, Saturday, September the 13th, 2008. The clock has not stopped since the previous evening. Inside Lehman Brothers' own offices, and inside separate conference rooms at the Federal Reserve Bank of New York, two rival teams of due diligence specialists, one from Bank of America, one from Barclays, continue working through the day, examining the same troubled balance sheet from two different angles, racing against a deadline that everyone in the building can feel tightening, hour by hour. By this point in our file, we already know what those teams are finding. The gap we uncovered at the end of the previous chapter between what Lehman Brothers claimed its commercial real estate and mortgage-related assets were worth, and what those same assets could actually fetch in the brutal market conditions of September 2008, is not shrinking under closer inspection. It is widening. And in the middle of this unfolding examination sat Dick Fuld, still even now, fighting for something that a growing number of people around him had quietly concluded was no longer realistically available, a deal that would preserve meaningful value for Lehman Brothers shareholders. Understand what this meant in practical terms during these negotiations. Fuld was not simply trying to save his firm from bankruptcy at any cost. He was pushing, in these final desperate hours, to negotiate a price for Lehman Brothers that reflected something closer to the firm's own internal estimate of its worth, rather than the sharply discounted valuation that Bank of America's and Barclays' analysts were now arriving at, after a night spent staring directly into the firm's books. This was the same instinct we examined at length back in Chapter 4. The same refusal to accept what Fuld considered an insulting price, the same underlying belief, sustained now across 14 years of vindicated judgment, that Lehman Brothers' true value remained higher than the market, And now even these two potential rescuers were prepared to recognize. But this time, the clock was working against him in a way it never had before. Every hour spent negotiating over price was an hour in which Lehman's cash position continued deteriorating, an hour in which trading partners around the world continued withdrawing, an hour closer to Monday morning when markets in Asia would open first, followed by Europe, followed by the United States, each one demanding an answer about Lehman Brothers' fate that, as of Saturday afternoon, nobody in that building could yet provide. Inside Bank of America's camp, meanwhile, a different kind of realization was beginning to take shape, one with far more serious consequences for the entire negotiation than Fuld's stubbornness alone. Ken Lewis and his team had spent the better part of a day and a night examining exactly the kind of assets described at the close of the previous chapter, and the picture forming in front of them was troubling on two separate levels at once. The first was financial. The scale of losses potentially embedded in Lehman's commercial real estate and mortgage portfolios appeared large enough that absorbing them fully as part of an acquisition could seriously weaken Bank of America's own capital position, precisely the kind of self-inflicted wound that responsible bank management exists to avoid. The second was legal and in some ways even more unsettling to a team of experienced corporate dealmakers. Bank of America's lawyers were increasingly concerned about the sheer scope of potential legal liability that could come attached to Lehman Brothers, given the scale, the complexity, and quite possibly the questionable accounting practices, echoing David Einhorn's earlier public accusations, sitting somewhere inside that mountain of mortgage-related securities. Acquiring Lehman Brothers might mean acquiring, alongside its trading desks and its office towers, years of future lawsuits that nobody in that data room could yet fully calculate or predict. Faced with this combination, a stubborn seller unwilling to accept a realistic price, and a target whose hidden liabilities appeared to grow larger the closer anyone examined them, Ken Lewis's attention, which we noted beginning to wander at the very end of the previous chapter, continued drifting toward an alternative that had begun to look, by comparison, remarkably attractive. Merrill Lynch. Merrill Lynch was facing its own serious problems that same September, problems rooted in many of the same mortgage-related products described throughout this file. But compared to what Bank of America's team was uncovering inside Lehman's books, Merrill Lynch appeared, at least on the surface, considerably cleaner. Fewer of the deeply troubled commercial real estate holdings, a more straightforward balance sheet, and perhaps just as importantly to Lewis, a acquisition that would instantly transform Bank of America into one of the largest wealth management and investment banking operations in the entire country, without dragging along the specific, deeply toxic real estate exposure that had made Lehman Brothers so uniquely dangerous. Throughout the day on Saturday and continuing into Sunday, Bank of America's team began holding quiet, largely separate conversations with Merrill Lynch. Conversations that, crucially, were not being conducted openly inside the room at the Federal Reserve Bank of New York, where officials and other bankers still believed, at least officially, that Bank of America remained a serious potential buyer for Lehman Brothers. This is worth pausing to underline because of exactly how it would land when the truth finally surfaced. Bank of America was not formally withdrawing from the Lehman negotiations, issuing a clear public statement that would allow everyone else in the room to adjust their own strategies accordingly. It was quietly pursuing an entirely different deal on a separate parallel track, while the broader rescue effort for Lehman Brothers continued operating, at least partially, under the assumption that Bank of America remained genuinely engaged. When word of the Merrill Lynch talks finally reached the wider group of officials and bankers gathered at the Federal Reserve on Sunday evening, the reaction, according to numerous later accounts, was something close to genuine shock, layered with a distinct undercurrent of betrayal. One of the two realistic paths towards saving Lehman Brothers had not simply failed. It had quietly redirected itself toward an entirely different target, while everyone else in the building had continued operating under the belief that both potential buyers remained fully committed to the deal in front of them. With Bank of America's attention now unmistakably elsewhere, the entire weight of Lehman Brothers' survival came to rest on a single remaining option: Barclays. Of the two potential buyers, Barclays, led in these negotiations by Bob Diamond, had, by Saturday, emerged as by far the more serious and more committed party. Diamond and his team continued working through Lehman's books with genuine intent, and by Saturday evening, the outline of an actual workable transaction had begun to take shape. Barclays would acquire the core of Lehman Brothers' business, its trading operations, its investment banking franchise, while a separate arrangement would need to be constructed to handle the most troubled real estate assets, potentially with some form of backstop or guarantee involving the other major Wall Street banks gathered in that room, the same institutions Paulson and Geithner had summoned 2 nights earlier. For a brief window sometime late Saturday night and into Sunday, this path appeared genuinely, tantalizingly close to working. The pieces were coming together. The numbers, while still difficult, seemed to be landing somewhere within the range of what all parties might, painfully, be able to accept. And then on Sunday, a different kind of obstacle emerged entirely. One that had nothing to do with balance sheets, mortgage losses, or negotiating tactics, and everything to do with something far more mundane and far more immovable: regulatory procedure on the other side of an ocean. Under British law, a transaction of this size and significance, a major British bank acquiring a foreign investment bank of Lehman Brothers' scale, required formal approval from Britain's financial regulator at the time, the Financial Services Authority, commonly known as the FSA. And critically, under the corporate governance rules Barclays itself operated under, a deal of this magnitude would also require a vote of approval from Barclays' own shareholders, a formal process that, under ordinary circumstances, takes weeks to properly organize and conduct. Barclays' negotiators pushed hard for an emergency exception, some accelerated form of approval that might allow the deal to proceed on the compressed timeline the crisis demanded. But British regulators, weighing the risks of approving a transaction of this scale and complexity in a matter of hours, rather than the weeks such review would normally require, declined to grant the kind of emergency waiver that would have made a Sunday night deal possible. Without that regulatory green light, and without a mechanism to complete a shareholder vote before markets opened, Barclays could not legally guarantee that Sunday the transaction it had spent nearly 2 full days carefully constructing. Back inside the room at the Federal Reserve Bank of New York, officials tried, quickly and with real urgency, to salvage the situation through direct diplomatic pressure. Phone calls were placed across the Atlantic from Hank Paulson's office and from officials inside the Federal Reserve, reaching out to counterparts within the British government and British regulatory bodies, attempting to convey the full scale and urgency of what was unfolding, and to encourage some form of expedited approval that might still allow the Barclays deal to proceed. These efforts, however forcefully made, ran directly into an obstacle that pure diplomatic urgency could not simply dissolve. British regulators were not merely being cautious out of habit. They were being asked to approve on an accelerated, effectively same-day basis, one of the largest and most legally complex cross-border financial transactions in recent memory, involving a firm whose own balance sheet, as we have now documented across 2 full chapters, contained exactly the kind of hidden, poorly understood risk that regulators exist specifically to guard against. Saying yes quickly under that kind of pressure carried its own very real dangers that British officials were simply not willing to absorb on Washington's compressed American timeline. By Sunday night, it had become clear to everyone gathered inside that building at 33 Liberty Street that the Barclays path, the last remaining realistic option on the table, had closed. The transformation in mood inside that room across this single weekend deserves to be described plainly because it mirrors almost exactly the emotional arc of this entire chapter. Friday night had opened with tension, wariness, and a kind of grim determination among executives summoned unexpectedly into an unfamiliar situation. By Saturday, that tension had sharpened into focused, exhausting urgency as due diligence teams worked through the night chasing a solution that still felt, at least theoretically, within reach. By Sunday night, urgency had curdled into something closer to genuine despair. Two potential paths forward, examined seriously, worked on around the clock by some of the most capable deal makers on Wall Street, had both, independently, collapsed within hours of each other. Bank of America had quietly redirected itself toward Merrill Lynch. Barclays, the more committed and more serious of the two suitors, had been stopped not by disagreement over price or by newly discovered financial risk, but by a procedural wall on the other side of the Atlantic Ocean that no amount of urgent phone calls from Washington could bring down in time. There were now, as this Sunday night wore on inside that Federal Reserve building, no buyers left on the table at all. Somewhere across the Pacific, the trading floors of Tokyo, Hong Kong, and Sydney were preparing to open within hours, ready to react in real time to whatever news emerged from this room before dawn. And inside 33 Liberty Street, the officials gathered there, having exhausted every private sector option available to them across 2 full days and nights of relentless, sleepless effort, now faced a decision that had no real precedent in modern American financial history. Whether to allow one of the oldest, largest investment banks in the United States, an institution that had survived, as we documented all the way back in Chapter 1, a civil war, 2 world wars, and the Great Depression itself to simply fail. Chapter 9, Sunday night, the fateful decision, Sunday evening, September the 14th, 2008. Slow down here. Everything in this chapter happens inside a narrow window of hours, and every one of those hours matters. So we are going to move through them carefully, almost minute by minute, the way an investigator walks a crime scene before anything is moved or disturbed. Inside the Federal Reserve Bank of New York, the news that closed the previous chapter has now been confirmed, formally in the room. Barclays will not be completing a deal tonight. British regulators have declined to grant the emergency approval that would have allowed the transaction to proceed on the compressed timeline this crisis demanded, and without that approval, there is no legal path for Barclays to close before markets reopen. The room absorbs this news the way a courtroom absorbs a verdict. Quietly, completely. And then every set of eyes in that building turns toward the same 2 men. Hank Paulson, Secretary of the Treasury, Tim Geithner, President of the Federal Reserve Bank of New York. For 2 full days, these 2 men, along with the rest of the officials and executives gathered at 33 Liberty Street, had been working under an implicit assumption that a private sector solution, some combination of a buyer, a consortium, a structured rescue, would ultimately emerge, the way it had for Bear Stearns back in March. That assumption had just been extinguished in a phone call from London on a Sunday night, with almost no time left before markets on the other side of the world would open and begin reacting to whatever happened next. Now, inside that room, a different kind of conversation began, one with far higher stakes than any due diligence review or price negotiation examined in the previous 2 chapters. Should the United States government intervene directly? Could the Federal Reserve simply extend emergency lending to Lehman Brothers the way it had helped facilitate the Bear Stearns rescue, keeping the firm alive by government action alone, even without a private buyer standing ready to take control? Reconstructing this debate from the many accounts given afterward by people who were present, it becomes clear that this was not a simple, one-sided discussion. Genuine, serious arguments existed on both sides, and they deserve to be laid out plainly here because they represent the actual difficult calculation facing American policymakers in the final hours before this decision was made. On one side sat the argument for intervention. Lehman Brothers, as we have documented across this entire file, was deeply interconnected with the rest of the global financial system, tied through trading relationships, lending arrangements, and overnight funding markets to nearly every other major bank in this room, and to countless institutions well beyond it. An uncontrolled collapse, some officials argued, risked triggering exactly the kind of cascading, self-reinforcing panic that had already begun quietly spreading through the overnight repo markets described back in Chapter 6. Better, this argument suggested, to find some mechanism to keep the firm alive, however imperfectly, than to risk finding out in real time exactly how far the damage from its failure might spread. On the other side, sat an argument rooted in a concept we touched on briefly in the previous chapter, but which deserves fuller explanation here because it sat at the very heart of this decision: moral hazard. In plain terms, moral hazard describes a very specific, well-documented problem that arises whenever someone is shielded from the full consequences of their own risky behavior. If a financial institution takes on enormous risk, chasing enormous profit, secure in the belief that the government will always step in to prevent a truly catastrophic outcome, that institution has very little genuine incentive to manage its risk responsibly in the first place. Rescue it once, this argument went, and you have not simply solved one company's problem. You have taught every major financial institution in the country a lesson. Take whatever risks you like, because ultimately someone else will absorb the consequences if it all goes wrong. Paulson, in particular, according to numerous later accounts, had grown genuinely concerned throughout that summer that the Bear Stearns rescue back in March had already sent exactly this kind of signal, further encouraging risky behavior across Wall Street rather than discouraging it. A second rescue, this time for an even larger institution, risked cementing that dangerous expectation permanently into the culture of American finance. But underneath this genuine substantive policy debate sat a far more concrete, far less philosophical obstacle, one that ultimately proved decisive, regardless of which side of the moral hazard argument any individual official found more persuasive. Legal authority. The Federal Reserve does not possess unlimited power to simply hand out money to any struggling financial institution it chooses. Under the specific laws governing its emergency lending power at the time, the Federal Reserve was required to lend against adequate collateral, assets pledged by the borrower that were sufficient to reasonably secure the loan being extended, protecting the public funds involved in case the loan was never repaid. Recall exactly how the Bear Stearns rescue back in March had actually worked. The Federal Reserve had not simply handed Bear Stearns a blank check. It had facilitated and financially backed an acquisition, with J.P. Morgan Chase standing behind the transaction as the actual acquiring institution, absorbing Bear Stearns' assets and its liabilities under J.P. Morgan's own corporate umbrella. The Fed's support existed within the structure of that private sector deal, not as a standalone rescue of Bear Stearns operating independently. Now, on this Sunday night, there was no equivalent structure available, no Bank of America standing ready to absorb Lehman Brothers, having redirected its attention, as we documented in the previous chapter, toward Merrill Lynch instead. No Barclays able to legally close its own proposed transaction before markets reopened. And critically, examining Lehman's own balance sheet, the very balance sheet that Bank of America's and Barclays' due diligence teams had spent 2 full days poring over, government officials and their own financial advisors concluded that Lehman Brothers simply did not possess sufficient, verifiable, high-quality collateral to legally justify the kind of large-scale emergency lending that might have kept the firm operating on its own. In plain terms, even setting aside every argument about moral hazard, even setting aside every philosophical debate about the proper role of government intervention in a crisis, the Federal Reserve, according to its own leadership's assessment that night, may not have had a clear legal pathway available to simply lend Lehman Brothers the money it needed to survive, absent a private sector partner willing to stand behind the transaction the way J.P. Morgan Chase had stood behind Bear Stearns. Faced with this combination, a genuine, unresolved policy debate about moral hazard, layered on top of a serious, concrete legal constraint, Paulson, Geithner, and their colleagues arrived sometime in the deepening hours of that Sunday night at the decision this entire file has been building toward since its very first page. The United States government would not intervene to save Lehman Brothers. Somewhere inside 745 7th Avenue, that decision reached the one man who had spent 14 years believing, with total conviction, that a moment like this one would never actually arrive. Picture the call itself. We cannot know every word exchanged in that conversation, but we know, with certainty, its essential content, confirmed across numerous later accounts. Dick Fuld was informed that the government would not be stepping in. There would be no 11th hour rescue. Lehman Brothers would need to file for bankruptcy protection. and it would need to do so before Asian markets opened for trading, only hours away now, in order to give the global financial system at least some measure of advance warning, rather than allowing the news to detonate in the middle of an active trading session halfway around the world. For 14 years, as Chapter 4 documented in careful detail, Dick Fuld had been the single dominant force determining Lehman Brothers' fate, a man whose fierce self-belief had been validated again and again by a stock price that rose more than 600% under his leadership. Now, in the final hours of a Sunday night in September, that entire 14-year arc arrived at its true, unavoidable conclusion. The decision that would end his firm's 158-year existence was being made, finally and completely, by other people in other rooms, and there was nothing left for him to negotiate, nothing left for his famous toughness, or his famous refusal to accept defeat, to actually change. And in a detail that deserves particular attention because of exactly how sharply it illustrates the true logic driving this entire weekend, a very different kind of announcement was unfolding at almost the exact same moment, just a short distance away. Bank of America, the same institution that had spent Saturday and much of Sunday quietly redirecting its attention away from Lehman Brothers, as documented in the previous chapter, formally announced that same evening its agreement to acquire Merrill Lynch in a transaction valued at approximately $50 billion. Consider the parallel structure of that Sunday night with real care, because it captures more precisely than any other single moment in this file the actual philosophy driving Paulson's and Geithner's decisions across this entire weekend. Lehman Brothers was being allowed to fail deliberately as a demonstration that reckless risk-taking would not always be rescued by government intervention. Merrill Lynch, facing many of the same underlying pressures, was at virtually the identical moment being actively encouraged by many accounts, quietly nudged along by officials eager to see it happen into the arms of a large, well-capitalized acquirer, precisely in order to prevent exactly the kind of second, even more destabilizing collapse that a Merrill Lynch failure arriving immediately on the heels of Lehman's might have triggered. One firm sacrificed, one firm saved through private means actively encouraged from just outside the frame. Both decisions, taken together on the very same Sunday night, reveal the calculated, if agonizingly imperfect, logic that Paulson and Geithner were attempting to apply to an unprecedented, rapidly unfolding crisis. Draw a line somewhere, accept one painful symbolic failure while doing everything possible behind the scenes to prevent that single failure from immediately multiplying into several more. Back inside Lehman Brothers' own offices, as the true magnitude of the evening's decision settled over the firm, a very different kind of urgent work began, this time conducted not by bankers or financial analysts, but by lawyers. Teams of attorneys, working through the deepest hours of that Sunday night and into the earliest hours of Monday morning, raced to prepare the formal legal documents required to place Lehman Brothers Holdings Incorporated into bankruptcy protection under Chapter 11 of the United States Bankruptcy Code, the legal process that allows a company to seek protection from its creditors while its assets are sorted, valued, and ultimately distributed or restructured under the supervision of a federal court. Try to picture the scene inside those conference rooms as this work proceeded. Lawyers who had, only days earlier, been drafting routine corporate filings, now assembling, at extraordinary speed and under extraordinary pressure, the paperwork that would formally end the existence of one of the oldest and largest financial institutions in American history. Every document represented, in the driest possible legal language, the final chapter of the exact story this entire file has been tracing since a small fabric shop in Montgomery, Alabama back in 1850. And somewhere within that building, quite possibly alone or nearly alone, sat Dick Fuld himself. Picture him now in the deepest, quietest hours of that Sunday night, a man who had spent 14 years as one of the most feared, most dominant figures on all of Wall Street, the gorilla, as Chapter 4 described him. A man whose instincts had shaped and reshaped an entire institution, now sitting with nothing left to negotiate, nothing left to fight, nothing left to do but wait for lawyers in another room to finish drafting the legal instrument that would end everything he had spent his career building. 14 years of unbroken success, and a 14-year record of a rising stock price that we examined in careful detail back in Chapter 4, had convinced Fuld, across that entire span, that his firm was different, that his judgment was sound where others had failed, that Lehman Brothers, exactly as it had survived a civil war, 2 world wars, and a depression, would find a way to survive this crisis too. That belief did not simply fade quietly over the course of this Sunday night. It ended decisively, completely, in a phone call, followed by the sound of lawyers typing in another room, followed by silence. At precisely 1:45 in the morning on Monday, September the 15th, 2008, the formal bankruptcy filing was submitted to the United States Bankruptcy Court in New York. Lehman Brothers Holdings Incorporated, an empire that had stood in one form or another for 158 years, officially ceased to exist as an independent institution. Chapter 10, 0 Hour, 158 Years, Undone in a Single Night, 1:45 in the morning, Monday, September the 15th, 2008. Somewhere inside a quiet office building in Lower Manhattan, a single legal filing is submitted to the United States Bankruptcy Court. No press conference, no cameras, no dramatic public announcement. Just a document moving through a court's electronic filing system in the dead of night, the way thousands of far less consequential documents move through that same system every single week. But this particular document carried a weight that almost no filing in American legal history had ever carried before. Lehman Brothers Holdings Incorporated, listing more than $600 billion in assets, had just become the largest bankruptcy filing in the history of the United States, a record that even now, years later, remains unbroken. For a few hours, in the deepest part of that night, the news existed only inside a small circle: the lawyers who filed it, the officials at the Federal Reserve, and the Treasury Department, who had spent the entire weekend examined in painstaking detail across the previous 3 chapters, arriving at this outcome, and a shrinking number of Lehman Brothers employees around the world who were beginning to receive word through phone calls, through internal messages, through the particular kind of silence that speaks louder than any announcement, that their firm no longer existed. Then the sun began to rise over New York City. By early morning, the story was no longer contained to a small circle of insiders. It belonged to the entire world. Television trucks and news vans began arriving outside 745 7th Avenue before most of the city had even finished its morning coffee. Camera crews setting up positions along the sidewalk, reporters conducting live broadcasts against the backdrop of a building that only days earlier had represented one of the most powerful addresses in global finance. And then came the image. The single image that would come to represent, more than any statistic, more than any government report, more than any congressional hearing that would follow in later years, the entire human cost of everything documented across the first 9 chapters of this file. Employees, arriving for what should have been an ordinary Monday morning, instead found themselves walking out. Dozens of them, then hundreds over the following hours, stepping through the same revolving doors they had walked through countless times before, this time carrying cardboard boxes filled with the contents of their desks. Framed photographs, personal mugs, small plants that had sat on windowsills for years, the physical residue of careers, some spanning decades, now reduced to whatever could fit inside a single box, carried out under the unblinking gaze of television cameras, broadcasting the scene to every corner of the planet. This chapter is going to slow down here deliberately because everything in the first 9 chapters of this file has moved through boardrooms, through negotiating tables, through the offices of chief executives and treasury secretaries and central bank presidents. This chapter belongs instead to the people who never sat in any of those rooms, who never had a vote in any of those decisions, and who were nonetheless about to absorb the full force of their consequences. Picture a young financial analyst, perhaps only 2 or 3 years out of college, who had taken a position at Lehman Brothers because it represented, for someone at the very beginning of a career in finance, one of the most prestigious addresses in the entire industry. She had spent the weekend, like most of her colleagues, hearing fragments of news, rumors passed between friends, half-confirmed reports on financial television, without any clear official confirmation of what was actually happening to the firm that employed her. Now, on Monday morning, she learns, along with the rest of the world, watching the same television coverage as everyone else, that the company no longer exists. There is no severance meeting scheduled, no orderly transition plan waiting to explain what comes next. Simply the abrupt, disorienting reality that the identity she had built her early career around, walking into that building each morning, introducing herself at industry events, has ceased to exist overnight. Picture, alongside her, a longtime executive assistant, someone who had worked inside that building for well over a decade, who had watched younger analysts and traders come and go, who had built genuine relationships, real friendships, with colleagues across the firm over many years. For her, this is not simply the loss of a job. It is the sudden, forced dissolution of a community she had belonged to for the better part of her adult life. A community built, as Chapter 1 documented in detail, on exactly the kind of fierce, tribal loyalty that had once helped Lehman Brothers survive a civil war and 2 world wars. And picture a trader, someone who had spent years on the very trading floors described back in Chapter 3, watching the market's confidence in Lehman Brothers erode day by day throughout that final summer. For traders especially, the wound carries a particular kind of sting, because many of them had understood better than almost anyone outside senior management exactly how serious the firm's situation had become in its final weeks. They had watched the warning signs accumulate in real time and had continued showing up, continued working, continued believing, or hoping that some solution would emerge before it was too late. None of these 3 people, the young analyst, the longtime assistant, the veteran trader, had ever sat inside the room at 33 Liberty Street. None of them had negotiated with Barclays or Bank of America. None of them had any say whatsoever in the decisions, examined at such length across the previous 3 chapters, that determined their firm's fate. And yet, all 3 of them, along with tens of thousands of colleagues around the world, in London, in Tokyo, in offices across dozens of countries, were now living through the direct, immediate consequences of choices made entirely without them, in rooms they had never entered, by people whose names most of them had only ever read in the financial press. While these deeply personal scenes were unfolding on the sidewalk outside 745 7th Avenue, a much larger, much more abstract version of the same shock was beginning to ripple outward across the planet's financial markets, exactly as feared throughout the tense negotiations of the previous weekend. Asian markets, the first major exchanges to open following the bankruptcy announcement, absorbed the news in real time and reacted immediately. Japan's Nikkei index and Hong Kong's Hang Seng index both fell sharply as trading began. Investors racing to reassess risk across their entire portfolios in light of a collapse that many, even after months of mounting warning signs, had still not fully believed would actually be allowed to happen. As trading moved westward through the day, following the sun from Asia into Europe and eventually into the United States, the pattern repeated itself, market after market, each one absorbing the same fundamental shock. If Lehman Brothers, an institution that had survived 158 years of American and global history, could actually be allowed to fail, then no assumption about which financial institutions were simply too important to fail could any longer be taken for granted. When American markets opened later that same Monday morning, the reaction was severe. The Dow Jones Industrial Average, the most widely watched measure of American stock market performance, fell more than 500 points in a single trading session, the worst single-day point decline the market had experienced since the days immediately following the September 11th terrorist attack 7 years earlier, a grim echo of the very anniversary that had opened Chapter 6 of this file. Consider for a moment the scale of what a 500-point single-day decline in the Dow Jones actually represents in the real world, beyond the abstraction of a number on a screen. It represents retirement accounts belonging to ordinary working people with no connection whatsoever to Wall Street, losing value in a single afternoon. It represents pension funds responsible for the future financial security of teachers, firefighters, and countless other public employees, absorbing losses tied directly to the collapse of a single investment bank most of those pension holders had never had any direct dealings with at all. The shockwave that began with a document filed at 1:45 in the morning was, within hours, reaching directly into the financial lives of millions of people who had never once set foot inside 745 7th Avenue. Against this backdrop of collapsing markets and displaced employees, one particular detail, emerging gradually in the days and weeks that followed, would go on to generate a level of public fury that arguably exceeded the anger directed at almost any other single aspect of this entire crisis. While thousands of ordinary Lehman Brothers employees walked out of that building on this Monday morning with nothing more than a cardboard box and uncertain future, it became widely known through subsequent financial disclosures and congressional investigations that we will examine more fully later in this file that senior executives, including Dick Fuld himself, had received extraordinarily large compensation packages in the years leading directly up to the firm's collapse, compensation that had already been paid out years earlier, based on profits generated by exactly the kind of aggressive, high-leverage bets on real estate and mortgage securities that this file has traced in careful detail from Chapter 2 onward, profits that, in hindsight, had never been real in any durable, sustainable sense at all. The optics of this contrast, ordinary employees losing their jobs and their financial security overnight, while the executives who had steered the firm into this exact outcome had already banked enormous personal fortunes in the years prior, would become one of the defining, most emotionally charged images of the entire financial crisis, fueling a wave of public anger that would eventually reshape American politics, financial regulation, and public trust in Wall Street for years to come. We will return to this anger and to its consequences later in this file. For now, on this particular Monday, as markets closed for the day and officials in Washington and at the Federal Reserve began assessing the damage of the decision they had made, one uncomfortable, deeply consequential realization was already beginning to take shape among the very people who had spent that weekend at 33 Liberty Street. Recall the core logic behind allowing Lehman Brothers to fail, examined at length in the previous chapter. The belief, or perhaps the hope, that this single painful failure could be contained, that allowing one institution to collapse might serve as a necessary symbolic lesson about moral hazard, without triggering an uncontrolled cascade throughout the rest of the financial system. By the end of this Monday, watching markets collapse across 3 continents, watching credit markets tighten further still, and watching fear spread through the financial system at a speed that outran even the most pessimistic projections made during that weekend's frantic negotiations, officials were beginning to an uncomfortable possibility. The containment they had hoped for was not holding, and they were about to discover exactly how right that fear was within a matter of hours, not days, as a very different kind of institution, one whose true scale of interconnection with the global financial system would prove even more dangerous than Lehman Brothers' own, arrived at the very edge of its own collapse. It was not a bank. It was not headquartered in the same downtown Manhattan neighborhood that had dominated this entire file. It was something far larger, far more deeply woven into the financial lives of ordinary people and major institutions around the world, in ways almost no one outside a small circle of specialists had ever fully appreciated until now. An insurance giant. 3 letters that, within the next 24 hours, would become just as urgent, just as consequential as the name Lehman Brothers had been all weekend long. AIG. Chapter 11. The Tsunami Spreads. A World on the Edge. By the end of the previous chapter, we had already begun to see it. The confident assumption held by officials at the Federal Reserve and the Treasury Department that Lehman Brothers' failure might be painful but contained was starting to crack within hours of the bankruptcy filing itself. This chapter is where that assumption fully collapses and where the true scale of the title of this entire file finally comes into view. Because what happened over the following days did not simply damage one company or even one industry. It reached into corners of the financial system that most people had never even heard of, and from there into the daily economic lives of people on nearly every continent on Earth. Let's begin with one of those corners, a place that, until this week, had represented for millions of ordinary investors, one of the single safest, most boring places imaginable to keep their money. Money market funds. For decades, money market funds had occupied a very particular, very reassuring place in the American financial landscape. Unlike stocks, which everyone understood could rise or fall, money market funds were marketed and widely understood as being essentially as safe as a savings account, a place where individuals, corporations, and institutions alike could park cash and expect with near total confidence that a single dollar invested would always be worth a single dollar when they wanted it back. This concept had a specific name inside the industry: maintaining a stable net asset value, commonly described in simple shorthand as never breaking the buck. One of the largest, oldest, and most respected of these funds was called the Reserve Primary Fund. And the Reserve Primary Fund, like countless other institutional investors across the financial system, had, in the ordinary course of managing its portfolio, purchased a modest amount of short-term debt issued directly by Lehman Brothers, debt that, right up until the bankruptcy filing described in the previous chapter, had been considered a perfectly reasonable, low-risk investment for a fund built entirely around safety and stability. When Lehman Brothers filed for bankruptcy, that debt became, essentially overnight, worth far less than its face value, quite possibly worth nothing at all. And because the Reserve Primary Fund had held enough of that Lehman debt, the losses were large enough that the fund could no longer honestly claim that every dollar invested was still worth a full dollar. On September the 16th, just one day after Lehman's collapse, the Reserve Primary Fund broke the buck. Try for a moment to imagine the psychological impact of this single event, rippling outward across millions of ordinary savers, corporate treasurers, and institutional investors who had, until this exact moment, considered money market funds essentially immune to this kind of loss. If one of the largest, most established funds in the entire industry could break the buck, seemingly overnight, triggered by exposure to a single failed institution, then no money market fund anywhere could any longer be assumed automatically safe. The result was immediate, and it was massive. Investors across the country and increasingly around the world began pulling their money out of money market funds in a genuine, full-scale panic, rushing to withdraw cash from vehicles that only days earlier had been considered barely different from a checking account. This wave of withdrawals threatened, in turn, to destabilize an entire corner of the financial system that many companies depended on for their own short-term borrowing needs, since money market funds themselves were significant purchasers of the short-term corporate debt that keeps ordinary businesses well beyond Wall Street able to meet their everyday payroll and operational expenses. This is precisely the mechanism through which a single bankruptcy filing involving a single investment bank began reaching directly into the financial plumbing that ordinary companies, and by extension ordinary employees far removed from Wall Street, depended on every single day. And the damage did not stop there. It moved next into an even more fundamental corner of the global financial system, the market where banks lend to each other. Recall from Chapter 6 the concept of the overnight repo market, the daily bloodstream through which financial institutions borrow and repay enormous sums, often literally overnight, simply to keep their operations functioning. In the days immediately following Lehman's collapse, that same instinct of fear and self-protection that had already begun quietly draining Lehman's own liquidity throughout that final summer now spread across the entire banking system, not confined to any single troubled institution, but touching virtually every bank, everywhere. Banks, suddenly and profoundly uncertain about which of their counterparts might be the next Lehman Brothers, an uncertainty made worse by the fact that virtually no outside observer had accurately predicted Lehman's own collapse until it was already unfolding, simply stopped trusting each other. Interbank lending, the routine, everyday process by which banks lend to one another to manage their own short-term cash needs, seized up almost entirely. This freeze showed up with startling clarity in a specific number that, until this crisis, most people outside of finance had never heard of, but which suddenly became a kind of daily barometer for the health of the entire global financial system: the London Interbank Offered Rate, commonly known by its acronym LIBOR. This rate, representing roughly the cost at which major banks were willing to lend to one another, spiked sharply upward in the days following Lehman's collapse, a clear, measurable signal that trust between the world's largest financial institutions had, in the space of a single week, nearly evaporated. When banks stop lending to each other, credit does not simply become more expensive somewhere in the abstract. It becomes harder for banks to extend loans to businesses, harder for businesses to finance their ordinary operations, harder, eventually, for those same businesses to make payroll or invest in new equipment or simply keep their doors open. The global financial system's bloodstream, examined in careful detail back in Chapter 6, was no longer merely under strain inside a single failing investment bank. It was seizing up across the entire body. And then only 2 days after Lehman Brothers filed for bankruptcy, an even larger, even more dangerous crisis arrived, one that would force American officials to confront directly and immediately exactly how wrong their hopes for containment had already proven to be. American International Group, better known across the financial world and increasingly in these very days across ordinary news coverage everywhere by its initials AIG. AIG was not a bank. It was one of the largest insurance companies on the entire planet, an institution most ordinary Americans associated, if they thought of it at all, with everyday insurance products, home policies, auto policies, life insurance. But hidden deep inside AIG's far larger, far more complex financial operations sat a business almost nobody outside a small circle of specialists had ever paid close attention to, a division that had sold enormous quantities of a financial product called credit default swaps, essentially a form of insurance, but insurance sold against the exact same mortgage-related securities, the collateralized debt obligations described all the way back in Chapter 2, that had already devastated Lehman Brothers and countless other institutions throughout this crisis. In simple terms, banks and investors around the world, many of them holding the exact same kind of mortgage-backed securities we examined earlier in this file, had purchased these credit default swaps from AIG specifically as protection insurance designed to pay out if those underlying mortgage securities ever collapsed in value. As the housing market deteriorated throughout 2007 and 2008, and as those underlying securities lost value in exactly the way this insurance was designed to protect against, AIG suddenly found itself facing potential payout obligations of a scale it had never adequately prepared for, obligations that threatened to bankrupt the company entirely within days. Here's the detail that made AIG's potential collapse so uniquely dangerous. More dangerous, in a very specific sense, even than Lehman Brothers' own failure. AIG had sold this insurance-like protection to banks and financial institutions across the entire world, hundreds of billions of dollars worth of exposure, woven directly into the balance sheets of major banks throughout the United States and Europe. If AIG collapsed and could not honor those obligations, the losses would not stay contained inside AIG's own walls. They would immediately cascade outward, directly striking the balance sheets of dozens of major banks around the globe. At the exact moment those same banks, as we just described, were already refusing to lend to each other out of pure escalating fear. Faced with this reality, American officials arrived at a conclusion strikingly, almost jarringly different from the one they had reached regarding Lehman Brothers only days earlier. This time, the United States government intervened directly and decisively. On September the 16th, the Federal Reserve announced an emergency loan to AIG of $85 billion in exchange for the government receiving a substantial ownership stake in the company, effectively taking control of the insurance giant to prevent its collapse. Consider the contrast now sitting directly at the center of this file and understand exactly why it would go on to generate such intense, sustained public controversy in the months and years that followed. Lehman Brothers, an investment bank with over $600 billion in assets, had been allowed to fail completely, its collapse justified, as we examined at length in Chapter 9, by concerns over moral hazard and genuine questions about legal authority. AIG, an insurance company whose collapse threatened to inflict direct immediate damage on banks across the entire world, was rescued within 48 hours with $85 billion in public money committed almost immediately. Why one and not the other? This question, why Lehman but not AIG, would become one of the most persistent, most politically charged questions asked throughout the entire remainder of the financial crisis, and for years afterward, during the congressional hearings we have already previewed earlier in this file, and in the broader public reckoning that followed. Critics across the political spectrum accused Paulson, Geithner, and the rest of the officials involved in these decisions of inconsistency, of a decision-making process that appeared from the outside to lack any clear, transparent, publicly articulated standard for determining which institutions were considered too interconnected, too dangerous to the broader system, to be allowed to fail, and which were not. Officials defended the distinction, pointing to the specific legal and structural differences examined earlier in this file. The absence of adequate collateral in Lehman's case, the presence of a viable ownership stake the government could take in AIG in exchange for its support, the different, arguably even more deeply interconnected role AIG's insurance products played across the global banking system. But to a watching public and to a great many members of Congress, the underlying appearance, one firm sacrificed, another firm saved, both decisions made within the same single week by the same small group of officials, was deeply, lastingly unsettling. And even as American officials worked to contain the immediate AIG crisis, the broader tsunami, unleashed by Lehman's collapse just days earlier, continued spreading outward, well beyond American shores, exactly fulfilling the fear that had haunted officials throughout that tense weekend at 33 Liberty Street. In Iceland, an entire national banking system, disproportionately large relative to the small country's overall economy, buckled under the same freezing credit markets and collapsing confidence spreading across the globe, ultimately forcing several of the country's largest banks into government control within weeks. Across Europe, major financial institutions found themselves suddenly, urgently exposed to exactly the kind of interconnected risk this file has traced from its very first chapters. Fortis, a major Belgian and Dutch banking group, required emergency government intervention to survive. Dexia, a large French and Belgian bank, faced a similar crisis, requiring its own emergency rescue within weeks of Lehman's collapse. Stock markets around the entire world, from Tokyo to London to Frankfurt to Sao Paulo, continued the pattern first documented at the close of the previous chapter, shedding trillions of dollars in combined value over the following weeks, as investors everywhere reassessed in real time exactly how deeply interconnected and exactly how fragile the entire global financial system had actually become. Back in Washington, watching this cascade unfold in real time, officials recognized with growing urgency that the piecemeal, institution by institution approach that had defined the entire crisis up to this point, rescue Bear Stearns, allow Lehman to fail, rescue AIG, was simply not going to be sufficient to stop a crisis that had now, unmistakably, become systemic, touching the entire architecture of global finance rather than any single troubled firm. The response, when it finally arrived, came at a scale unlike anything the United States government had ever attempted before in peacetime. The Treasury Department proposed, and after considerable political turmoil, including an initial stunning rejection by the House of Representatives that itself triggered another sharp stock market decline, Congress ultimately passed a program called the Troubled Asset Relief Program, widely known by its acronym TARP, authorizing the government to spend up to $700 billion purchasing troubled assets and injecting capital directly into the banking system in an effort to restore the basic confidence and functioning that had been so thoroughly shattered across the preceding weeks. Behind every one of these enormous, almost unimaginable figures, 85 billion here, 700 billion there, trillions in market value erased worldwide, sat the same kind of real human consequences we examined so carefully in the previous chapter, now multiplying far beyond a single company's workforce. Layoffs spread rapidly across the financial industry and well beyond it, as companies in nearly every sector, facing frozen credit markets and collapsing consumer confidence, began cutting jobs to survive. The housing crisis that had started this entire chain of events, examined all the way back in Chapter 2, deepened further still as tightening credit and a weakening broader economy pushed even more American families toward foreclosure. And perhaps most lastingly of all, public trust in the entire financial system, in banks, in regulators, in the very idea that people running the largest institutions in the country actually understood and could responsibly manage the risks they were taking, suffered a blow from which it would take many years, arguably an entire generation, to even begin recovering. As the immediate panic of these extraordinary weeks slowly, gradually began to subside, one question, more than any other, remained hanging over the wreckage of everything this file has documented so far. Not simply what had happened, but who exactly would be held responsible for it, and whether anything meaningful would actually change to prevent a crisis of this scale from ever happening again. Chapter 12, Legacy and Lessons. The file is closed, but the story is not over. Every case file eventually reaches its final pages, not because every question has been answered. Rarely in stories of this size is that ever truly the case, but because a moment arrives when the immediate crisis has passed, when the panic has subsided, when the people involved are called at last to account for what they did and did not do. For the story of Lehman Brothers, that reckoning arrived gradually over the months and years that followed the events documented across the previous 11 chapters of this file. It arrived in one of its most visible forms inside a congressional hearing room in Washington in the year 2010. Picture the scene. Dick Fuld, the man Chapter 4 described in such detail, the gorilla of Wall Street, a chief executive whose 14 years of unbroken success had once made him one of the most respected, most feared figures in all of American finance, now seated at a witness table before the House Committee on Oversight and Government Reform, facing pointed, often deeply skeptical questioning from elected representatives broadcast live to the entire country. The questions directed at Fuld during these hearings and during related testimony he gave before other congressional committees in the years that followed returned again and again to the same core themes this file has traced from its earliest chapters. Why had Lehman Brothers continued expanding its exposure to real estate and mortgage-related securities throughout 2007, even as warning signs, examined in careful detail in Chapter 3, accumulated across the industry? Why had internal critics, like Mike Gelband, been sidelined rather than heeded? Why had Fuld repeatedly rejected potential deals throughout the first half of 2008, deals that, in hindsight, might have allowed Lehman Brothers to survive in some form rather than collapsing entirely? Fuld's answers across these various hearings remained largely consistent with the psychological portrait this file drew of him back in Chapter 4. He maintained, under sustained questioning, that Lehman Brothers had ultimately been the victim of circumstances beyond any single individual's control, a broader, systemic panic that swept through the entire financial system in September of 2008, rather than the direct, foreseeable consequence of decisions made specifically inside his own firm, under his own leadership. Watching this testimony, it is worth returning one final time to the tragic paradox we identified at the very close of Chapter 4. The same unwavering self-belief that had once made Dick Fuld a celebrated, even legendary figure on Wall Street, the refusal to accept defeat, the total confidence in his own judgment, remained fully intact, even now, even after the empire he had led for 14 years had ceased to exist. It is a portrait, in many ways, of a man whose greatest strength and whose fatal blind spot had never actually been two separate qualities at all. They had always been the very same trait, viewed from two different angles, at two very different moments in his career. A year after these hearings, in 2011, the broader official investigation into the causes of the entire crisis reached its own conclusion. The Financial Crisis Inquiry Commission, a body established specifically by Congress to examine exactly what had gone wrong across the American financial system, released its final report. The Commission's conclusion, stated plainly in its opening pages, carried significant weight precisely because it directly contradicted the argument Fuld and many other Wall Street executives had continued to offer in their own defense. The financial crisis, the Commission concluded, was not some unavoidable, unpredictable natural disaster. It was avoidable. The report went on to detail across hundreds of pages a long list of specific identifiable failures that closely mirror the very structure of this entire file. Failures of risk management inside individual institutions, echoing everything we examined in chapters 2 through 5. Failures of the credit rating agencies examined in chapter 2, whose conflicted incentives had allowed dangerously risky securities to be labeled as among the safest investments available. Failures of government regulators, who had possessed, in many cases, the legal authority to identify and rein in exactly the kind of excessive risk-taking and leverage documented throughout this file, but who had largely failed to exercise that authority in time to prevent the crisis from reaching the scale it ultimately did. And yet, alongside this damning official assessment of systemic failure, one particular fact, confirmed and reconfirmed in the years following Lehman's collapse, would go on to generate its own distinct, lasting controversy, separate from the broader debate over regulatory reform. Despite the scale of the collapse, despite the accusations of misleading accounting first raised publicly by David Einhorn back in Chapter 5, despite years of subsequent investigation by regulators and by congressional committees, Dick Fuld himself was never criminally charged in connection with Lehman Brothers' collapse. Nor were most of the senior executives who had led the firm through the decisions this file has documented in such detail. This outcome, no criminal prosecution reaching the very top of an institution whose collapse had triggered a genuinely global financial crisis, became, for many members of the public watching this story unfold, one of its most difficult, most lastingly frustrating chapters. Millions of ordinary people had lost their jobs, their homes, or a significant portion of their retirement savings in the wake of decisions made by a relatively small number of executives at a handful of major financial institutions. And yet, in case after case across the broader crisis, not simply at Lehman Brothers alone, criminal accountability at the very highest levels of Wall Street leadership proved in practice to be extraordinarily rare. Legal experts and prosecutors who examined these cases in the years that followed generally pointed to a specific, if deeply unsatisfying, explanation. Proving criminal fraud under American law typically requires demonstrating clear, deliberate, intentional deception, a genuinely difficult legal standard to meet when much of the conduct in question, the aggressive risk-taking, the excessive leverage, the questionable accounting judgments, could plausibly be explained, at least in a court of law, as recklessness, poor judgment, or simple overconfidence, rather than deliberate, provable criminal intent. It is a distinction that offered little comfort to the millions of people who had directly experienced the consequences of that recklessness, but it remains to this day one of the central, unresolved tensions running through the entire legacy of this crisis. If criminal accountability for individual executives proved elusive, the crisis did produce one genuinely significant structural response, arriving in the form of new legislation. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, widely known simply as Dodd-Frank, representing the most substantial overhaul of American financial regulation since the reforms that followed the Great Depression itself, examined all the way back in Chapter 1 of this file. Dodd-Frank attempted directly to address many of the specific vulnerabilities this file has traced across its previous 11 chapters. It established new mechanisms for identifying and monitoring systemic risk, the kind of deeply interconnected, cascading danger that allowed a single investment bank's collapse to spread within days into money market funds, interbank lending markets, and eventually a massive insurance company, exactly as documented in Chapter 11. It imposed significantly stricter capital requirements on major banks, directly targeting the kind of extreme leverage that roughly 30-to-1 ratio described back in Chapter 2 that had left Lehman Brothers so acutely vulnerable to even a moderate decline in asset values. And it created new regulatory bodies specifically tasked with overseeing exactly the kind of complex, opaque financial products, the mortgage-backed securities and collateralized debt obligations detailed throughout this entire file that had proven so dangerously difficult for outside observers and apparently for many insiders as well. to fully understand or accurately price. But offering a fully balanced accounting of this reform, as this file has attempted to do throughout, requires acknowledging that Dodd-Frank's legacy remains, even years later, a matter of genuine, ongoing debate, not a settled, universally accepted verdict. Critics on one side of this debate, including many economists and consumer advocates, argue that Dodd-Frank, while an important and necessary step, still fell short of fully addressing the underlying vulnerabilities exposed by this crisis, leaving significant gaps that could still allow a similarly severe crisis to emerge again in the future, perhaps built around a different set of financial products or a different corner of the system that current regulation does not yet adequately address. Critics on the other side of this same debate, drawn largely from within the banking industry itself, argue that Dodd-Frank imposed regulatory burdens that went too far, adding significant costs and compliance complexity that, in their view, constrained lending, slowed economic growth, and disproportionately burdened smaller community banks that had played little to no role in the excesses documented throughout this file, while doing comparatively little to rein in the very largest institutions the reforms were originally designed to address. This file will not attempt to resolve that ongoing debate for you. It is, in many ways, a live, unfinished argument still playing out in Washington, in academic economics departments, and inside the banking industry itself, more than a decade and a half after Dodd-Frank first became law. What this file can offer instead is the observation that both sides of this argument are responding to the exact same underlying tension, a tension this entire investigation has circled since its very first pages. How much freedom should financial markets be given to innovate and to take risks in pursuit of growth and opportunity? And how much oversight is genuinely necessary to prevent that same freedom from occasionally producing exactly the kind of catastrophic systemic failure this file has spent 11 chapters documenting in detail? Beyond the specific question of financial regulation, the crisis left a deeper, more diffuse mark on American public life, one that extended well beyond Wall Street, well beyond Washington, and into the broader relationship between ordinary citizens and the largest institutions governing their economic lives. In the years immediately following the crisis, a new wave of public protest emerged, most visibly in a movement that took root in Lower Manhattan itself, not far from the very buildings this file has spent so much time inside, a movement that came to be known as Occupy Wall Street. Its specific demands were often diffuse, sometimes difficult to summarize in a single sentence, but its underlying grievance traced directly back to the events documented throughout this file. A deep, widely shared sense that a relatively small number of powerful financial institutions and executives had taken enormous risks, generated enormous personal wealth in the process, examined specifically in Chapter 10, and then largely escaped the direct personal consequences of that risk-taking, while millions of ordinary people who had never sat inside a single meeting at 33 Liberty Street absorbed the resulting damage in the form of lost jobs, lost homes, and shattered retirement savings. That underlying sense of grievance, of a fundamental asymmetry between risk and consequence at the very top of the financial system, did not disappear once Occupy Wall Street's encampments eventually dispersed. It has continued to echo in various forms through American political life in the years since, shaping public attitudes toward large financial institutions, toward economic inequality, and toward the broader question of whose interests exactly the country's largest institutions ultimately exist to serve. Which brings this file finally to the reflection with which it must close. Across 12 chapters, we have traced a single continuous thread, beginning with three immigrant brothers selling fabric in a small Alabama storefront in 1850, and ending with a formal bankruptcy filing submitted in the dead of night, 158 years later. Along the way, we have examined the specific mechanisms, the mortgage-backed securities, the collateralized debt obligations, the extreme leverage that turned an ordinary economic downturn into a genuine, cascading global crisis. We have studied the specific individuals, Dick Fuld above all, whose particular combination of talent, confidence, and ultimately blindness shaped this story's final tragic chapter. But underneath all of that specific detail, The dates, the dollar figures, the individual names sits a far simpler, far more timeless observation, one that applies well beyond the particular story of a single investment bank. This is a story about the razor-thin, often nearly invisible line between confidence and arrogance, between genuine financial innovation, the kind that has across centuries helped build railroads and finance entire industries, examined back in Chapter 1, and reckless speculation, dressed up in sophisticated language specifically designed to obscure how much genuine risk it actually contained. Between the legitimate freedom a market economy requires in order to innovate and grow, and the equally legitimate responsibility of public oversight, needed specifically to prevent that same freedom from occasionally metastasizing into exactly the kind of systemic catastrophe this file has documented in such careful detail. Every one of the individuals who appears in this file, Dick Fuld, Joe Gregory, Hank Paulson, Tim Geithner, and countless others whose names appeared only briefly across these 12 chapters, believed at the specific moment each of their consequential decisions was made that they were acting reasonably given the information and the pressures in front of them at that exact moment. And yet, taken together, those individually reasonable decisions produced one of the most damaging financial catastrophes in modern history. That, perhaps, is the single most unsettling lesson this file has to offer. Catastrophic failure rarely announces itself in advance as catastrophic. It typically arrives instead as a long accumulation of individually defensible decisions, each one made by reasonably intelligent people, none of whom, at the specific moment of decision, can fully see the larger pattern their choices are quietly assembling. So we leave you at the close of this file with the same question this entire investigation has been building toward from its very first page. Have the lessons of Lehman Brothers actually been learned, absorbed deeply enough to meaningfully change behavior the next time overwhelming confidence, dressed up as financial innovation, tempts another generation of ambitious executives toward exactly this same kind of excessive risk? Or does financial history, as it has so often done across the centuries, simply find new products, new institutions, and new confident leaders through which to repeat, in a slightly different costume, the exact same fundamental mistake? We began this file in the pre-dawn hours of a September morning, watching employees walk out of a Manhattan office tower carrying cardboard boxes, a single image that, within hours, would circulate to nearly every television screen on the planet. Return to that image now, one final time, but look at it differently than you did back in our prologue. You now know everything that led to that particular sidewalk on that particular morning. You know about the fabric shop in Alabama. You know about the mortgage machine and the AAA ratings that concealed its true risk. You know about the warnings that were raised and ignored. You know about the man at the very top, whose 14 years of triumph had quietly, invisibly hardened in the one blind spot that would prove fatal. You know about the sleepless weekend inside a limestone building at 33 Liberty Street, where a handful of powerful men made a decision whose consequences reached, within days, into money market funds, insurance giants, and stock markets on nearly every continent on Earth. The boxes carried out of that building that morning did not simply contain photographs and coffee mugs. They contained the final physical evidence of everything documented across this entire file, the tangible remains of an empire that had survived a civil war, 2 world wars, and a Great Depression, brought down in the end not by any single external enemy, but by choices made over years, like inside its own walls. This file is now closed, but the questions it raises about confidence and arrogance, about innovation and recklessness, about freedom and responsibility remain very much open, carried forward, whether we choose to remember them or not, into whatever comes next.